Good morning. Just going to go over some individual tax updates here, the first hour of the webinar. I'm going to kick it off with some of the permanent tax cuts that were instituted this year. And I like to always say there is nothing permanent except change, because keep in mind that when we go over permanent tax cuts or tax changes, and we say something is permanent in tax law, we all know that that's subject to change still. So it's permanent until someone changed something. So under our current law, we now have extended the 10 and 12% brackets past 2025. So for 2025 and the foreseeable future, we still have 7 tax brackets: a 10, 12, 22, 24, 32, 35, and 37% brackets. The tax brackets will remain in place again after 2025. So with those lower tax brackets made permanent, this may allow for opportunities to strategically manage your income from year to year, and then to consider strategies like Roth conversions while you're in lower tax brackets here for the foreseeable future. Again, those permanent changes are subject to change at some point, but we now do not have that cutoff here at the end of 2025, so we have a little more flexibility. Just to give you a little bit of an idea of where some of those brackets cut off in 2025, we always like to pay close attention to this. You can see at certain brackets it jumps further than others. So 12% to 22%, that's a 10% difference. And then also you have a pretty wide bracket here between 22% and 24%, before you then have a pretty large jump from 24 to 32%. So a single, married, filing separate, you get these lowest brackets up to about $48,475 in 2025. And then you're looking married, filing, joint at $96,950 before you jump to the 22%. So you have those two expanded lower brackets up until $96,950 for married. And then you would jump, from 24 to 32% at around $394,600 for 2025 if you're married filing joint, or $197,300 if you are single or married filing separate. So kind of keeping some of those bracket changes in mind, especially when you're doing things like considering strategies and managing your income between brackets. You want to pay close attention to when it jumps, specifically from 12 to 22 and 24 to 32%. In addition to the permanency of the brackets and expanded brackets, we also received permanent increases to the standard deduction, and then also coupled with that is the termination of the deduction for personal exemptions. So we had that come into play in 2018, and then it was supposed to, at the end of 2025, revert back to the old tax law. However, that did change this summer under OBA. So the 2025 standard deduction we knew was single and married filing separate, $15,750 for 2025. Married filing joint is $31,500 standard deduction, and head of household $23,625. Again, that will now continue into 2026, and we have some numbers for 26. If you're planning out that far, it'll go up to $16,100 in 2026 for married filing separate and single, and up to $32,200 if you're married filing joint, and head of household $24,150. So that will be the 2026 numbers, again continuing that trend, increasing the standard deduction. Another permanent tax cut we received this summer does actually impact 2025 itself. The $2,000 child tax credit was reduced to $1,000 after this year, but we still had it at $2,000 for 2025 originally. With the passing of OBA this summer, that did permanently increase the child tax credit to $2,200, and that actually begins this year, 2025. And then, and I did look, this will continue to be $2,200 in 2026, although they are to be making, indexing it for inflation, including the refundable portion. So, but it does stay at $2,200, 25 and 26, with the refundable portion being $1,700, up to $1,700. The phase outs do start for the tax credit at $200,000 of modified adjusted gross income, and married filing joint $400,000. I did want to point out child tax credit can only be taken if you have under 17 years of age at the end of the year. So once your child hits 17, that credit no longer applies, and you would be looking at the other dependent deduction credit of $500. And that also has been permanently extended. To qualify for the child tax credit, both you and your spouse and each of your children must have Social Security numbers. You must be, that child must be a family member, so a descendant or descendant of your family. So sons, daughters, stepchildren, your siblings qualify, grandchildren, nieces, and nephews. They cannot provide more than half of their own support. They must live with you more than half of the year, and they need to be claimed as a dependent on your tax return. They need to be a U.S. citizen, a U.S. national, or a U.S. resident alien in order to qualify for the child tax credit. And I wanted to just bring up those reminders today because when you do see the new 1040 for 2025, you'll see there's a bit of an expanded section in the dependency area where you list your dependents. And there are some additional check boxes for some of these items, such as support and whether or not they're a citizen or not. And so these things are, if you live there, lived with you more than half of 2025 and in the United States, also whether or not they're permanent, on permanent disability or a full-time student. All of these things are now check boxes right on the face of the 1040. So important reminders to keep in mind. Once your child hits 17 and they're still a full-time student, that's where the other dependent credit comes into play. You still need to be claimed as a dependent, but this is any age. A lot of the other restrictions do not apply. You still need to be a U.S. citizen, and they need to have either a Social Security number, an ITN, or an adoptive taxpayer identification number. So keep those things in mind. Also, need to keep in mind that when you apply for these credits, refunds are not allowed to be issued prior to the middle of February by the IRS. So, you're not going to get this quick turnaround early February or late January. When e-filing opens, you'll have to kind of wait for your refunds. I have our first polling question here. True or false? The highest individual ordinary income tax bracket continues to be 37% under OVA. True or false? And it looks like most of you got that correct at 91% being true. That does continue to be, the 37% continues to be our highest individual tax rate. No tax on tips. So this has gotten a lot of traction this year, and so we're getting into the heavy meat of the new stuff that we're going to see on the individual tax returns this year. No tax on tips basically doesn't mean that it's not taxable. You still continue to keep these items in your taxable income. However, it will allow up to a $25,000 deduction for qualified tips in certain occupations. So they were supposed to give us a list of occupations by October 2nd, and of course they did issue those in proposed regs in September of 2025. They list these Treasury tipped occupation codes. There are 3-digit codes that will get reported on forms W-2 or 1099 for our or some sort of report. all those will need to include this 3-digit tip. There's 8 categories, and they're very specific, every code, but I won't go over every type of occupation that qualifies, but basically the 8 categories are beverage and food services, entertainment, hospitality and guest services, home services, personal services, personal appearance and wellness, recreation and instruction, and transportation and delivery services. So there are a list of very specific occupations underneath each of these categories in the proposed regs that were issued in 2025. Again, that 3-digit code will need to be reported both to the employees and then also on your individual tax return in order to take this up to $25,000 deduction for those qualified tips. Qualified tips are voluntary cash or charge tips from customers or through a tip sharing process. It is something to keep in mind, that voluntary word, and in the proposed regs, we do have a little bit more information about that. Cautionary item here, if it's an automatic service charge, sometimes you go to a restaurant and they have, for like large parties or something, a specific amount in gratuity or service charges. Those are not considered voluntary, and therefore those would not be qualified tips, even if you do share those. So again, kind of keep just a word of caution on there of what is a qualified tip. It must be voluntary from the customer, not be something that's automatically charged. Also, another word of caution for this year, the IRS has told us that they are not updating the W-2 forms for 2025. However, they already issued drafts of the 2026 W-2, which is quite interesting. They have added on the 26 W-2 a box 14B, which will show the, so it gives us a little bit of idea of what they're looking at reporting wise going forward, which would include the 3-digit code and the qualified tip amount. Originally, we thought we might be able to use box 7 and that we wouldn't have a separate reporting requirement. It is important to note, but because they are not changing the 2025 form, that in 2025, the IRS will give transition relief. So they did just recently issue some relief notes that do let us know some examples of what you can use. And one of the things that they are allowing is to use box 7 tipped wages just for this year in 2025. And if that is considered a reasonable box to use on your 1040 for the deduction. And we'll kind of go over that a little bit later, the new forms that are available for this on the 1040. But for 2026, it'll show up in box 14B. For 2025, a lot of employers, we're recommending and we're providing for payroll that we do, box 14, which is the box that you can kind of manipulate into reporting whatever it is that you need to report as an employer to your employees. So we might see it on your W-2 in box 14. You should use that if you get that. Otherwise, because of the relief, you could use box 7 tips and or a pay statement as well. So if you have a paycheck that shows your tips, you can also use that as a measure of reporting in 2025. But again, that's for 2025 only, and that's your transition relief. You must file a joint tax return if you are married in order to take this deduction. That's very important. You do not get this deduction if you file separately, if you are married and file separate return. Also, the deduction phases out for taxpayers with modified adjusted gross income of $150,000 if you're single and $300,000 if you're filing a joint return. It is also important to remember that this is a temporary deduction currently implemented for tax years 2025. So it does start this year and it would end in tax year 2028 if not extended.
Hey, Sherry, on that, just not to put you on the spot, but thinking about the occupations that were listed, any kind of come to mind that was surprised on it or not on the list?
That's a good question. Nothing was super surprising to me when I looked over the list. It's a lot of like, think hairdressers, that type of thing. There were actually the list is fairly extensive, actually. So if you're not sure if you would qualify, trying to think, I had it brought up here, but I must have closed that to look through it again. Oh, here it is. No, maybe not. Yeah, when I looked through it, I don't have it up anymore, but yeah, when I looked through it, I didn't see anything that was a super big surprise. Something to keep in mind, because of course everybody wants to qualify for this deduction, right? And the whole voluntary from your customers is a pretty big deal. So you can't just carve out some of your income as tips, right? Because it also does apply to self-employed individuals. So like say you're, self-employed hairdresser, barber, and you get tips, there's a form 4137 where you have to report that information, but the key will be documentation of this, and that it is voluntary, right? They also specifically say that the SSTBs do not qualify. So there's a list of about 10 types of occupations that specifically are excluded, right? And that would be like your health services. You can't give tips given to your doctor or your attorney for law services, your accountants. Anybody wants to tip us, we can't report them because we can't take a deduction for qualified tips. Actuarial services, performing arts and consulting, athletes, financial services, brokerage services, those types of things specifically are excluded from the occupation, right, list. But it is important that you will have to put the actual 3-digit code that they provide. And then underneath each one of these categories is like, so beverage and food services are the hundreds. And then there's a whole list of specific occupations underneath that qualify. So yeah, nothing that really surprised me. Did you look at the list at all? That anything surprised you?
Yeah, no, I thought it was a pretty good complete list of things, but of course, if you tip your accountant, it's not a qualified qualified tip. Just as a reminder.
Yep. So moving on to no tax on overtime. Also, overtime, this is an area that we've received quite a bit of guidance in since OBO came out in July. It does allow a deduction. Again, it's not that there's no tax on overtime. That's kind of what it was sold as, I want to say, or talked about as talking point. It's really a deduction. It allows up to $12,500 deduction for single individuals and $25,000 joint deduction. Again, this is another deduction that if you are married, you must file a joint tax return in order to take the deduction for overtime. It is qualified overtime compensation. That is the amount that exceeds a regular rate of pay. So keep that definition in mind. And it's typically the half portion or the time and a half portion that is required by the FLSA. So that FLSA rules, regulations, is something that we've had to really dig into deeper than I think that we maybe have done in the past in order to figure out exactly what qualified overtime compensation really is. Again, this is to be reported on W-2s by your employer. So when you get to the 1040 side, you should just be able to put that information in your return. However, again, they're not updating the W-2 for 2025. The draft 2026 W-2 will show that in the future, we'll see this number show up in box 12 with a specific code number, letter. However, that's not going to be where it is this year because they're not changing the W-2, and the W-2 box 12 requirements are very specific. You can't just put in there whatever you want to, right? So I would look for this number either in box 14, listed as qualified overtime premium, or you can also this year with the transition relief, You can use a pay stub. I will tell you right now that number may or may not be correct. Depends very much on how overtime wages are reported by your employer. Because again, it is only the piece that goes over your regular rate of pay. And then a lot of times we think regular rate of pay, so say you make $15 an hour, you think that that's your regular rate of pay, right? Because that's your regular time hourly rate. Not necessarily. So the FSLA regulations would have you include bonuses, commissions, other payments that you may get in addition to your regular pay, that if you have to add up all of that, divide by your number of normal working hours in a week, that then calculates your regular rate of pay, right? So if you get those other things, I mean, if you're just a straight hourly employee, you don't get anything else, bonuses or anything, then maybe this, isn't as difficult. But there are a lot of times where this is going to be a bit more of a challenge for the employers than you may otherwise assume. The other thing is that a lot of times you might say overtime hours and you put the entire amount of overtime rate that you get paid and not just the premium portion of your pay on a pay stub. So that's something that employers are needing to look at right now, going to need to report in some way to their employees. But don't be surprised if what you think your overtime rate is from your pay stub, and then you get something reported on your W-2 or a separate statement from your employer isn't exactly the same, or it's less for your qualified overtime premium. Don't be surprised, because I imagine that's going to be the case. Also, if your employer pays you double time for like holidays or some other day of the week, that also is not a requirement by the FLSA, but something that your employer allows or does or provides. That does not qualify. That additional amount that they gave you, the other half of the time that they pay, is not considered qualified overtime compensation when it comes to this specific deduction. So just some things to keep in mind if you are an employer or if you receive overtime and are going to take advantage of this. Again, transition relief in 2025 for everybody. But the employers are trying to get this right, the ones that we've talked to, and it's very complicated. Can be very complicated. Another thing to keep in mind for my ag clients or ag workers, agricultural workers are not regulated by the FLSA, and therefore their overtime wages do not qualify for this specific deduction, which was kind of a little bit of a surprise for us, right? One of the surprises in this specific one. I'm going to caution everybody for these two deductions specifically, just keep an eye out on your tax software. Because I do know that this is the case for our software, but for others on the call who may use something else, keep an eye out for where your tax software provides this information. Ours is actually utilizing the 2026 draft W-2 as the input information for these deductions. So you kind of need to be cognizant that while they didn't change the 2025 W-2s forms, we have that draft 26 W-2, so we know where it's going to go in the future. Not sure why they didn't just go ahead and do it for 25 since they have the 26 forms drafted, but that's what we have this year as far as transition relief. But just keep that in mind if you are preparing a return that has one or both of these deductions. This deduction also phases out, just to mention, it's a slightly different phase out range. No, it's the same phase out range as $150,000 for single modified adjusted gross income and $300,000 for joint. So if you are in one of those situations, there will be a phase out for this deduction as well. Okay, no tax on Social Security. So this is what's been called, it's really a deduction for seniors, right? Because it's really very much, doesn't have much of anything to do with Social Security at all. So it provides an additional senior deduction of $6,000 per eligible individual age 65 or older at the end of the year. If both spouses are eligible, both over 65 or 65 or older, the additional deduction is $12,000. So it is $6,000 per individual person. It is whether or not you are taking Social Security at age 65 or not, you still get this deduction. So it is not really linked to Social Security, as many clients that are not taking Social Security at age 65 yet. But it does phase out when your modified adjusted gross income is over $75,000 if you're single, $150,000 joint. Again, you must file a joint tax return if you are married. And it is temporary from 2025 to 2028. I do want to mention, in looking at the forms, it reminded me there's a couple of things in the tax law that are age-based, right? And you may or may not be surprised to know this, but several of those things, if you turn 65 on January 1st, so if you're a New Year's baby, your year that you turn, your tax year that you turn a certain age is oftentimes different than the actual year you turn that age. So if you happen to be turning 65 on January 1st, 2026, you will qualify for this deduction on your 2025 tax return, okay? So for whatever reason, and this is several areas, or an income tax credit, a couple of areas, I've seen it a couple of times. If you happen to be a New Year's baby, you have a different year of birth, you get to be a little bit older sooner than everybody else, right? Car loan interest deduction. So the other new deduction this year is an above the line deduction starting in 2025 for personal car loan interest. So the maximum deduction is up to $10,000. It phases out when you are over $100,000 of modified adjusted gross income for singles, $200,000 for joint, so a little bit different phase out. The vehicle must be for personal use, and it must be new, and final assembly must be in the United States. And it says, you know, the VIN must be reported, and we're going to go over the form here in a minute. The loan must also be secured by the vehicle, and lenders must provide information returns and furnish those statements to the taxpayers. There is a new form, a Form 1098 VLI, vehicle loan interest, that you should receive if you're in this situation and potentially have this deduction. So just like you get a mortgage interest statement, that's a 1098, you would also get a Form 1098 VLI for your vehicle loan interest, personal loan interest. Okay, getting to the additional deductions form. So there is a new Schedule 1A in the 1040 this year that will then report all 4 of these specific deductions. They're not part of your itemized deductions. They are not an adjustment to adjusted gross income. They are after what we refer to as above the line deductions, below the line deductions, I should say, after adjusted gross income is calculated, outside of your itemized or standard deduction. So these are just additional deductions that'll show up on your 1040. So brand new schedule for each of them. You will see the very first part of this, you will go over and calculate your modified adjusted gross income, which will, for many, many people, will just be your adjusted gross income, unless you have foreign income exclusion or some other type of income. No tax on tips section here. It pulls that information. You have to have one of those 3-digit codes. You put that information on here, and then it has the phase out section. No tip on overtime, same thing. You put in your qualified amount of overtime. It has a max amount that you're allowed to deduct up to the $25,000 if joint, $12,500 if you're single. And then it goes through the modified income phase out thresholds calculation. No tax on car loan. You can see right here, you have to put your vehicle's VIN number If there's an amount that's deducted on a schedule, on a business schedule, that is not personal use, right? That you do have to report that on here, because you can split that up if there's like if you're using actual expenses and you're using a percentage of that as a deduction somewhere else. Only the personal piece will be deducted here. Again, it goes through the phase outs of the thresholds, and then the enhanced deduction for seniors is also reported on here in detail, goes through the threshold phase outs. So you will add up any and all of these deductions that you happen to qualify for, and then that will carry to the 1040. Again, this is just an additional, we had the schedules that came out whenever they changed the 1040, when they added all the additional schedules separate from the 1040 itself. We now are back to 2 full pages of a 1040, but we still have all those additional schedules, and now we have one more 2-page schedule, 1A. I keep wanting to call it A1 because of the Schedule A itemized deduction, but it's Schedule 1A. State and local tax deduction, again, that has been a $10,000 cap since 2018, and was set to expire at the end of 2025. However, we not only got an increase going forward, we got an increase starting this year in 2025. That cap is now $40,000, and then it will increase 1% annually through 2029, and then in 2030 it would then revert back to $10,000. Now there is a phase out for the additional $30,000 deduction piece, and that begins when your modified adjusted gross income exceeds $500,000 in 2025. And then these phase outs also increase 1% annually through 2029. The deduction is reduced by 30% of the amount the taxpayer's modified adjusted gross income exceeds the threshold, but it's never reduced below the $10,000. So even if you're subject to the phase out, it's only for the additional $30,000 deduction, and is not and will not take you below the $10,000. Just one planning point on this, pass-through business owners in high tax states should evaluate their benefits of electing for a pass-through entity tax to bypass this cap and the modified adjusted gross income limitations. We'll talk about that a little bit more in Maryland. Pennsylvania is one of just a handful of states that do not have the pass-through entity tax election for your S-corps partnerships, but that is a good planning point if you happen to have income from a pass-through in a lot of our surrounding states, New Jersey, New York, Maryland. So there are 36 states that do have that. And then just a reminder, the limits and the thresholds are per return, and that's no matter your filing status. Okay. And I'm going to turn it over to Matt.
Yeah, and just a comment on the, as we go through the polling question here, but just looking at the SALT change in the cap. I mean, looking at, as we're going through some planning here at year end for 2025, it's really interesting to see for those individuals below the threshold of what it's doing to itemized deductions, and more people definitely qualifying for itemized deductions instead of the standard deduction in those situations.
Yeah, that's a really good point. And then especially for your PA clients who or taxpayers who don't get the itemized or standard deduction, but in states where Maryland, where you have to do what you do on the federal return and you don't get the income tax deduction on your state return, it's really interesting. You really have to play the numbers both ways.
Yeah.
The overall liabilities.
So as you'll see here, the results have come in, and top one being 40,000 as being the answer. So good job. And we will move on. So the next up, we wanted to talk a little bit about when talking about itemized deduction, the new deduction limit. So years ago, prior to TCJA coming into place, there was what was called the PEAS limitation, which looked at your total itemized deduction, and for some higher earners had limited your itemized deductions, so that if you're coming up with $100,000 of itemized deduction, you look at what's actually coming through, and well, it's less than 100,000 because in the background you were calculating this fees limitation that was very complex. That had gone away under TCJA because of some of the other changes that were made to the itemized deductions. What is now put in place as part of OBA and starts in 2026 is a new limitation that essentially is for anybody in the 37% bracket. And there's kind of this, it says reduced by 2/37 of the amount exceeding the threshold of being in the 37% bracket. Sounds very complex, but essentially in simplistic terms is basically if you're in a 37% bracket for ordinary income taxes, you're only getting a 35% deduction for your itemized deductions, essentially is what's happening. And as you'll see here, what we have listed where the 37% bracket starts for single and head of household being $626,351, married filing joint at $751,601, and married filing separate $375,801. And again, this starts in 2026. So there is some planning there for 2025, as I'll get into I think in the next slide with charitable contributions, that there is a little bit of maybe opportunity to do some planning with itemized deductions in 25. So charitable contributions outside of, when we look at itemized deductions outside of the state and local tax deduction change, this is the other, probably the area where you have some planning that you could do and look at to maximize whether you're going to be taking itemized deductions or if you're in the standard deduction is better. There is a couple changes that were made this summer as part of OBA. It all comes into play in 2026. So again, it really is, we're looking at 25 and what could we do in 25 to maximize the tax benefit versus the impact that OBA has starting in 26 on a couple pieces of this. So the one good thing with the charitable contributions that came out of OBA is starting in 26, if you are not itemizing your deductions and you're taking the standard deduction, what will come back into play is a $1,000 for single and $2,000 for married filing joint charitable deduction. If you made that through cash contributions, you will be able to take that as a deduction in addition to your standard deduction without itemizing. So that was, a couple years ago during COVID, we had seen similar, but I think smaller amounts that was in place, was beneficial to taxpayers that they made some charitable contributions, but not enough, or didn't have other itemized deductions to get the benefit. So at least you get a tax benefit there for some of those cash contributions. OBA also extended or made permanent the 60% of AGI limitation for cash contributions. So that was set to sunset after 2025 to go back to 50%, but the OBA had made that permanent to be 60% going forward. One of the negative pieces when it comes to charitable contributions from the OBA standpoint was a limit that is being put in place starting in 2026 is a 0.5% floor or AGI reduction to other otherwise deductible amounts. You know, think of it like the medical deductions, which is a much higher floor, but essentially, if you're itemizing, you have charitable contributions, not until you get over that 0.5% floor of the AGI do you get a benefit for charitable contributions. So just to put it in an example, for a very high income earner, if their AGI is $1 million, that 0.5% floor is $5,000. So the first $5,000 of charitable contributions do not qualify as an itemized deduction. So not until you get over that 5,000 do you get a benefit. So really, as a planning point here is looking at, you know, if you're in the 37% bracket, you know, 2025 is from a tax standpoint going to give you a better benefit to get charitable contributions because of the floor, because of the new limitation on itemized deductions. You know, if you're in that 37% bracket, you're losing 2% of itemized deductions starting in 2026. Plus, you have the floor in there to lose a little bit more. So if you're looking at, you know, doing large charitable contributions, doing it before the end of 2025 could make sense depending on your situation. You can do that through bunching or using donor advised funds. So there's a lot of different options there that, you know, we've been working with clients to try to maximize, you know, your deduction there. The one other thing, real quick, I'm going to go back to charitable contributions. Not is part of anything that changed here, but just as a reminder for the qualified charitable distributions, which we see a lot with, you know, retirees. So qualified charitable distribution is for anybody 70 and a half or older. And a lot of times, you know, we see it, you know, for people either that they have an IRA, that they have an RMD, or they will in the future since the RMD ages have been pushed back further than the 70 and a half. But it gives you an option to directly take a distribution from your IRA and give it to charity, directly to charity, not taking it as income. And so it's not a charitable contribution for itemized deduction purposes, but it also is not taxable income or does not get included as part of your AGI. So, you know, we talk a lot about AGI, it affects a lot of different things. So having a lower AGI, not taking it into your income, could help in other areas where there's limitations or other things calculated using the AGI. In 2025, the maximum amount that you can do as a qualified charitable distribution is $108,000, and that is one of the areas where it had changed so that it's indexed for inflation to change different years. One of the things that OBA had also done was permanently terminated certain other itemized deductions that were gone from TCJA, but they were subject to come back after the sunset of 2025. But OBA had permanently terminated casualty loss deductions, except for those that are federally declared disasters. OBA also added to that state declared disasters. So a lot of times what we were looking at before was, you know, it had to, so you're looking at hurricanes, you know, tropical storms, different things that could rise to the level of a federally declared disaster area. And a lot of states sometimes were waiting on the federal government to declare it that in order to reach the situation that somebody could deduct it as a casualty loss. But they had added some provisions to allow states that the state had declared it a disaster and as long as the Treasury agreed that it could still qualify for this deduction going forward. Other item, permanently terminate miscellaneous itemized deductions. So that being investment expenses. Think about you receive brokerage statements showing different investment expenses, accountant fees for just personal tax return prep, lock boxes, stuff like that were miscellaneous 2% itemized deductions. Those were not been available the last several years.
That was a big one that people lost. Yep.
Yeah.
Other planning point about that, sorry, Matt, just, from if you were somebody who would have benefited from that unreimbursed employee expenses like mileage and that type of thing, a home office, work with your employer, maybe do an accountable plan, negotiate that as something that would be a deduction for your employer and then also not taxable income to you, something like that to kind of work around the fact that you would lose that deduction, continue to lose it.
Yep, good point. Thank you. Moving expense deductions, so those have been terminated except for it is still available for active duty military and employees of the U.S. intelligence community is the only place where the moving expense deductions are allowed from an itemized deduction standpoint. OBA had also made permanently the limits on the mortgage acquisition indebtedness, being the $750,000 of mortgage, unless you are grandfathered into previous mortgage that's at the $1 million limit from years ago before TCJA had come into place. And then home equity interest deduction. So being that the only time you can deduct that is if it's for buying, building, or improving a home, personal residence. And then one of the new things that was part of it was gambling losses being subject to only being able to take 90% of losses as itemized, and this starts in 2026. So basically, if you have $100,000 of gambling winnings and you have more than that of losses, you're now subject to only 90% of those winnings you can offset by losses. So so that you would always have some kind of winning that would be taxable. I know there's been a lot of pushback on that from with a lot of the online gambling and a lot of different things along those lines. So be interesting to see if there's any changes. This only goes into play in 2026. One of the other new things was Trump accounts. So essentially these are tax deferred saving accounts for minors that are pretty much, they're modeled after IRA account. It will work like an IRA account. And the contributions, basically this contributions aren't allowed until 12 months after the enactment of OBA, which, so July 4th, 2026 is when contributions would start to be allowed to be put into these accounts. At this point in time, you can't even set them up yet, but there is more information that has been released about them. There will be, I think next Wednesday, there's another announcement coming from the White House on some more information. And then in 2026 is when a lot of the actual setup and implementation of these accounts will be happening. But basically the contributions will be capped at $5,000 per year. And those contributions are not deductible. But one of the options that you can possibly do is that employers can make contributions to these accounts for employees and the employees' dependents. And if it happens that way, it will not be included in taxable compensation. The government, the Treasury, will be crediting up to $1,000 when opening an account for a child that's born from 2025 through 2028. The investment is restricted to mutual funds, ETFs that basically follow like the stock market fund, so S&P 500, certain things like that. So that's very, very strict on what you can and can't invest in. And distributions are not allowed until age 18. And then once attaining age 18, you can start making distributions. However, as I mentioned, it's treated like an IRA. So basically it will be kind of converted to an IRA at that time. And if you make a distribution that does not meet one of the exceptions, like qualified higher education expenses, first home purchase, it would be subject to the additional 10% early withdrawal tax. So just keeping that in mind. Basically, the whole point of these is to get money into funds early on for children, let it grow, kind of have a nest egg to whether it's using for education, using for future, way down the line in future to try to grow those funds. So definitely an interesting investment strategy, and letting income basically grow for different purposes without touching it. But like I said, a couple weeks ago or last week, I think, the IRS and Treasury had issued Notice 2025-68, which contain a lot of information on how families can opt into it, and it announced upcoming proposed regulations. So it kind of went a little bit into there's a form that will be available to.
Did you hear what the form number is?
4547. Yeah.
Can't say they don't have a little humor.
Yeah. So it has some more information, but again, there's still a lot of pieces that have to come into play. There will be an online portal to sign up. The notice that came out kind of went into some of the minutia of the accounts, the taxability, the administration of it, talking about when, who can open up this account. And there's kind of a hierarchy of legal guardian, parent, sibling that you have to go through, and that once an account is established for somebody, nobody else can open up an account, initial account for that child. So there's a lot of different pieces, I think, that they're working to just make sure that there's not all these different accounts being opened up, especially from a fraudulent standpoint and a lot of other things. So again, a lot more to come on that. And that brings us to the next polling question, which is, what individual tax provision is most relevant to you? And it looks like it's pretty close between lower tax rates made permanent and the SALT deduction increase. Share it, maybe not personally, but what are you seeing with clients on kind of this? What are you seeing the kind of the most relevant things?
It's definitely the state and local tax deduction increase, which is, take a little planning too, to see how that's impacting people, especially in states that have the PTET, the pass-through tax. Additional deduction for seniors. I apparently have a lot of seniors in my client base.
All right, just a few other various provisions that are in there related to individuals. State and gift tax exemption has increased to $15 million per person. That's starting in 2026 instead of it reverting to 5 million that it would have gone to if no changes had been made. And this has been made permanent with inflation adjustments after 2026. So, there's a lot of planning being done in the last couple of years just because of, fear of estate exemption dropping drastically. This doesn't necessarily change all of that, but for certain, individuals, when you look at 15 million per person and 30 million for married filing joint with portability, it's a big number there. But there still is some other, estate and gift planning that can be done just to make sure you're accomplishing your goals there. What's not here but is of relevance in kind of the same sense of the gift tax exemption is annual gifting amount exclusion is $19,000 per person in 2025 and 2026. So just keep that in mind. Usually at the end of the year, that's kind of one of the common questions, and just how to use that up just to move some funds around to family members, do some gifting, and keep under the annual exclusion so that there's no reporting having to be done. The AMT exemption was also made permanent at higher levels, indexed for inflation, and then but it steepens with the phase out for those with income exceeding $626,350 for single and $1,252,700 for joint. And then the adoption credit was made refundable up to $5,000 and adjusted for inflation as well. And the 529 plans, there's some items in there to expand what was eligible for it. So definitely, if there's you're looking at that for K through 12 or post secondary, there's definitely looking at the changes that were made there and whether it's applicable, of some expenses that might be included that you can use 529 plans for now. Just to name a few, with K through 12, expanded to include instructional materials, standardized test cost, tutoring, and then it also, before the cap was $10,000 for K through 12 that you could take as distributions annually for those expenses. For after 2025, the cap actually doubles to 20,000. So that's, want to keep that in mind. And then also starting with the enactment of OBA, so starting July 4th, 2025, it applied to post-secondary credentialing programs, licensing, apprenticeships, and then also the tuition fees, books, supplies, and equipment for those types of programs as well. So not just college and university, but some of those other vocational, type schooling and credentialing as well is now being included with that. And with that, we will go to Q&A.
Perfect. So we do have a few questions. I'm thinking we might have more questions than we have time for. But what I'm thinking is we'll just address a few now, and then if we have time at the very end, come back. And then if not, follow up after the webinar ends via email. So the first question that I'm going to pitch to you guys is, if we say that we count ETO and holidays towards regular time, is the overtime still excluded from the calculation for overtime that can be excluded?
No, the FSLA does not allow that paid time off and holidays to create overtime premiums. It's not something that's regulated. So if you're doing that as an employer, or your employer does that, that's something that they do above and beyond the requirement and is therefore not qualified overtime.
Perfect. And then the next question, for the overtime premium, The bonus that you mentioned to be included in the regular rate of compensation is only non-discretionary. Is that correct?
No. So, I mean, if you give a bonus that is discretionary, that's still probably going to be included. I'm not positive about that, so I can follow up with that person if it's a specific question. Contact our HR
Okay.
or payroll department on that.
Perfect.
Sure.
And then I'll give you guys one more, which is, how does no tax on overtime pertain to agricultural workers?
So agricultural workers, you do need to review if you think that you have an agricultural worker or are one. There are specific services you kind of have to dig into it a little bit more. It's not an overarching, like you may have an employer that has some ag workers that are not covered by the FSLA, and then some other workers that are not necessarily. So it's my understanding that it is very geared into what services they provide for that. But there is, if they are not an occupation that is, their overtime is not regulated by the FSLA, then it is not considered qualified overtime.
All right, we will be moving to the business tax update, and Ryan will be joining me here.
Good morning, everybody. Thanks, Sherry and Matt, for the individual update. It was all good information. And we're going to move into the business tax update section. And basically what we're trying to accomplish here today is we're going to provide an update of the business tax changes that we have for 2025. Usually on these annual updates, there's not too much going on. One or two things here or there changes. This year was obviously very different with the OBA coming into play. So there are numerous and substantial changes on the business side that everybody needs to be aware of as we head into filing season next year. So we're going to spend a lot of time going over those changes. We discussed some of this information back in August when we did our OBA webinar. There's been some additional guidance and direction and clarification, but there's still a lot that we're expecting to get guidance, rev procs, things like that on as we move forward. So we're going to have to, in some of these cases, just go off what the statute is saying at this point until we get further clarification. But we'll talk about that. Also comparing the old rules, kind of like Matt and Sherry did with the new provisions to help you understand what changed. And then factoring in all these changes and what are some potential things to think about, as these new rules are implemented for our clients. So all right, so one of the biggest changes included in the OBA tax bill was that bonus depreciation was restored to 100% for property that was qualified property that was acquired and placed in service after January 19th, 2025. Looking back to where we were under the TCJA rules, we had 100% bonus depreciation for several years, and over the past 2 years it had been phasing down to 80% 2 years ago to 60% last year, and then it was supposed to be 40% in 2025, and it was set to completely phase out. Well, essentially what this did is just got rid of the phase out and brought it back, and it basically, you're going to be able to expense, if it's qualified property, 100% of anything that you put in service after January 19th. bonus depreciation in general applies to tangible personal property that has a recovery period of 20 years or less, and certain real estate improvements. But also included in the new law was they expanded the scope under Code Section 168N to allow for the 100% expensing of manufacturing buildings that were placed in service before January 1st, 2031, which is a pretty significant addition to the bonus depreciation rules. So we're going to talk about that a little bit as well. Obviously, what they're trying to do here is to encourage capital investment now by businesses by, allowing a full deduction in the year that you purchase and place the equipment into service. So, like I said, the 100% bonus depreciation is now going to be the general default. So if you have qualifying property placed in service acquired after January 19th, 2025, it's going to be, bonus depreciation is going to be 100%. Since we talked over the summer, they did put a transitional election in there. And basically what that allows is that, taxpayers can elect to take 40% bonus depreciation in place of the 100% bonus depreciation during this first taxable year. It's optional election, so you can choose to do it, or you can just go with the default, which is 100%. Why would they do this? I think really it was flexibility, probably for planning that was done previously. If you had done planning with taking 40% depreciation, making someone take 100% might not be great for them. So I think that's why they did it. And not that it really matters to us because we have software that can handle this, but depreciation, as easy as the concept of it is, it gets very, very complicated with all the rules and everything. Our software will handle it based upon the dates that we use, but it may simplify the calculations for some people. So I think that's why they did it, but it's just another tool that we have as we're working through the tax returns this year, and it's possible that it could come into play, or it might be advantageous or worthwhile to make that election. So just something to remember. So the depreciation for qualified production property is the Code 168N, which I had alluded to a little bit earlier. Basically, this is going to provide a 100% bonus depreciation deduction for qualified property placed in service before January 1st, 2031. There are some more dates that I'm going to talk about in a minute because I think the dates are very important as to whether this qualifies. But the definition of qualified production property, it includes any portion of a non-residential real property, so commercial real estate, used as an integral part of qualified manufacturing, agricultural, or chemical production, or refining a qualified product that results in a substantial transformation of the product, i.e. manufacturing. So really what they're trying to do is encourage investment in manufacturing facilities here in the United States with this new rule. There are certain things that are excluded. At the current time, there's been no guidance issued on this. So I was really hoping that we might get something because some of these exclusions, I can see where there's going to be gray areas on this, and hopefully that guidance comes out sooner than later. But you're not allowed to take this accelerated depreciations on real property that are unrelated to manufacturing, and also any food or beverage prepared in the same building as a retail establishment in which it is sold. So if you, I think of like maybe a tap room or something like that, or some kind of food services where the manufacturing or preparation is occurring is not going to be eligible. And then also property used by a lessee is not considered to be used by the lessor as part of a qualified production activity. So if you have a building and lease it out, that's not going to be something that you're going to be able to do. The property, you know, if there's two ways you can approach this. You can build the facility, or you can actually acquire an existing facility. If you acquire an existing facility, the property can't have been used in any qualified production activity by anybody at any time, essentially for the past 4 years, prior to when you purchase it and put it into service, or you know, for your manufacturing activity. So it's not going to acquire. They're looking to generate new manufacturing facilities and investment rather than existing. So if you're looking to buy a facility and want this deduction, you're going to need to make sure that it wasn't used for manufacturing for the prior 4 years. This applies to property placed in service after July 4th, 2025, but before January 1st, 2031. Construction had to begin after January 19th, 2025, and before January 1st, 2029. So there's specific dates, contract. You couldn't have been in a contract to do this prior, that would kick it out. But you know, it seems like a lot of time to potentially use this. But when you're talking about, you know, construction of a manufacturing facility, the planning, you know, the projections, everything else that you need to do, including the construction, you know, if this is something that, you know, someone wants to take advantage of, it may be useful to look at this sooner than later, so you're not running out of time at the end, because it is a very significant tax deduction. One of the other tools that we have is when you acquire property and equipment is 179 expensing, and everybody's very familiar with that. Basically, the new OBA increased the amount of 179 deduction that you can take to $2.5 million, essentially doubling it, because it used to be at 1.25 million prior to the new tax bill. So the other thing to note is that if you put too much property that qualifies for a 179 deduction in service, it actually starts to phase out as well. Previously, that was at $3 million. You started to get a phase out of the amount of deduction that you could take. That's now increased to $4 million. So it gives you a little bit more flexibility and room to take full advantage of the 179 deduction. This applies to property placed in service in tax years beginning after December 31st, 2024. So the thing to remember with 179, so there's a couple things to think about here as we look at this. With 179 depreciation, you can't drive yourself into a loss situation. You have to have business income to offset it. Contrast that with the bonus depreciation. Bonus depreciation is able to drive you into a loss situation. Both of these code sections give you the ability to deduct 100% of the property that you place in service, or the qualified property that you place in service, but there are different things that you need to consider, such as, you know, do I have a profit? Do I not have a profit? Do I need to drive myself into a loss? I can use that loss to offset something else. You know, am I pushing up against the phase out of this thing? And then another consideration, I might have this on the next slide here. Oh, we got a polling question. Let's just get with the polling question and I'll finish up after this. Starting in 2025, what is the new maximum Section 179 expense deduction limit under the OBBA? All right, so we got a bunch of different answers here, but $2.5 million is the correct answer. $1.5 million or 1.25 million was the previous limitation. So I started talking about this. The 179 depreciation can create a business loss, whereas bonus depreciation can. There's also an important factor to think about is the state treatment of bonus depreciation in 179. There are a lot of times, every state's different, but I know that Pennsylvania and Maryland essentially do not allow bonus depreciation. They allow a very, Maryland allows a very small $25,000 limit. And Pennsylvania, for example, allows 179 now, whereas they didn't used to. Maryland doesn't. So you might think that you've taken out all your income on the federal side of things and then be surprised when you get to your state return to see a huge add back and a huge taxable income. So there's some interplay between those two there that should be considered also when you're evaluating this at the end of the year. The other things to think about are, does it make sense to, a lot of times, I talk to my clients about, a lot of times people want to put something in the service before the end of the year to save taxes on it, but they may not necessarily need that, piece of equipment. So I always say that, you don't buy something just for the sake of the tax deduction. You purchase it because it's something that you need for your business. It's going to help make your business better, generate profits, income, and maybe you accelerate it, pull it forward, because buying something just for the depreciation deduction, is not going to really work out all that well. And you also want to consider debt service on, a lot of times when you're making big equipment purchases, there's debt that accompanies that, unless you can finance it internally. So if you take all your depreciation up front, essentially you're not going to be getting any deductions over the next 5-7 years, whereas you're going to have debt service on that piece of equipment and having to pay back the principal and interest. So sometimes it can create a mismatch, and you're having higher taxable income paying higher taxes in years that you're actually trying to service the debt. So just another thing to think about. And then also you have to think about future taxable income when making depreciation decisions, because you get more benefits when you're going to be in a higher tax bracket. So especially with pass-through entities, if you're thinking that, hey, next year I'm going to be, in the 35 or 37% bracket, whereas this year I'm only in the 20-24% bracket. Well, if you take all the depreciation this year, you get it up front and a year ahead of time, but you could be missing out on 15% income tax savings if you would have held off and done this in the future years. So another thing to mention with 179 depreciation is it's at the taxpayer level. So if you have multiple businesses and they all take up to $2.5 million of 179 depreciation, by the time you get to your personal return, it's not going to look very good because it's going to be limited to just the $2.5 million. So you have to think about all the entities that are involved as well, future tax brackets, debt service, state rules. So it's pretty simple concept, but there's a lot of things that you have to consider when evaluating the depreciation at the end of the year. So another big change that happened this summer was the 163J business interest deduction, which was introduced as part of the Tax Cut and Jobs Act back in 2017. And essentially, this is one that I never really fully understood, because basically what it does is if you are a qualified business or a large business, which means, well, in 2025, it means that your revenue is for the past, your average revenue for the past, or gross receipts for the past 3 years are $31 million or higher. Basically, what they're saying is you have to go through this calculation to calculate this adjusted taxable income, and we're only going to allow you to deduct interest expense up to 30% of this adjusted taxable income. So for the first couple years on this thing, it didn't really have much of an impact because the adjusted taxable income calculation was based on EBITDA, meaning you could take your taxable income and then you would be able to add back the depreciation and amortization that you had taken before you made the 30% calculation, which created a much higher base for you to take your interest deductions. But in 2022, what happened is they dropped off the depreciation and amortization from that category. And essentially what we were finding, there were a lot of businesses, the larger businesses that, have significant depreciation, especially with the additional 179 and bonus. And so they were having to make this calculation without adding that back, which severely limited the amount of interest that they could take, and a lot of it was being disallowed and carried forward. Luckily enough, what happened this summer with OBA is they reinstated the EBITDA-based adjusted taxable income calculations for years, for basically 2025. So we're going back to the old rules where you can add back the depreciation that you take and increase the base where you're allowed to take the interest expense. So I would expect to see a lot of easing on that for our clients, and potentially even some interest, if we've had to limit it in the past, could be freed up over the next couple years under this new calculation. So overall, it was very favorable. Moving forward, the other thing that happened as a part of this code section was there was a bonus depreciation conflict. I think we saw it a lot in dealerships because floor plan interest was something that you could deduct and was kind of outside the realm of this limitation. However, if you did that, then you were unable to claim bonus depreciation. So, which, it's pretty significant. So what they did was they got rid of that rule as well. So now that even if you're a business that has, and you are deducting floor plan interest, you can now claim the 100% bonus depreciation. So overall, very favorable. Again, I don't know why. This one puzzles me a lot because of just the businesses that have to borrow more, paying interest are limited and paying more tax. It's just counterintuitive, but this is definitely a step in the right direction. So I think we'll see some of these freeing up this year, and it's definitely going to be more favorable to everybody. Another big item from the OBA this summer, beginning with under the old rules, under the Tax Cut Jobs Act introduced in 2017, essentially you were able to take a 20% deduction on your qualified business income. This was put in place really to make the rules for C corporations more comparable to those of pass-through entities as corporation and partnerships. Anyway, it was a significant reduction. 20% of your business income is a significant deduction, and that was actually slated to end at the end of 2025. So we would have still had it for 2025, but it would have gone away in 2026. essentially what the bill did this summer was it permanently extended that deduction for the future. So you no longer have to worry about that going away, at least temporarily. Like Sherry said, permanent is really temporary, but permanent is better than temporary. So, we expect that to continue into the future. And one of the other things that they did was they did increase. So the qualified business income deduction, there's rules where it is phased out, and we talked a little bit about the specified service businesses earlier, the professional businesses, accounting, legal, broker. If you are above certain limits, I think I wrote those down here. Yeah, if you're single, once you go above $197,000 to $247,000, your deduction, that 20% deduction, starts to phase out. And if you're married filing joint, starts to phase out at $395,000 up to $495,000. So if you're in those specified service industries, you're still going to have that phase out moving forward. And one of the other things that it did was it did expand that phase out range heading into 2026. So it does increase the amount by about $50,000, where you can still get a benefit if you're in one of their specified service activities. So again, this was very positive. The rules didn't change other than that. Very positive development, should give more clarity moving forward and take out some of the worry of that potentially being taken away. Okay, we're at another polling question here. Under the OBA, the qualified business income deduction for pass-through entities has been eliminated, made permanent, reduced to 10%, or phased out for high earners. The correct answer is made permanent. See, most of you got that correct. Okay, the last thing that I'm going to talk about here is limitations on excess business losses of non-corporate taxpayers. Under the old Tax Cut and Jobs Act, if you had losses in excess of $250,000, $500,000 for a joint tax return, essentially those losses were limited. They gave a max loss that you could take for that activity passing through your tax return, and the disallowed amount was allowed to be carried forward. You wouldn't lose it for good; it would just carry forward, and then you could take it as a net operating loss in succeeding years. The new tax law permanently extends this disallowance for excess business losses, but it does index the $250,000 and the $500,000 for inflation moving forward after 2025, and retains the NOL carryover treatment for succeeding years. So overall, those numbers should go up into the future, and if you find yourself in a situation, you should have more ability to deduct some of those losses kind of moving forward. All right, I think Matt's going to take over here.
Yep. So one of the other provisions that was part of OBA this summer was focused around the small business stock gain exclusion. So under TCJA and some previous provisions, basically what was available was exclusion from gain on the sale of qualified small business stock that was held for more than 5 years. And if it was acquired after September 27th, 2010, the exclusion was 100%. And stock before that period, the exclusion was between 50% and 75%, with a per issuer limitation of $10 million. So what OBA had introduced was a tiered gain exclusion based upon the holding period. And this, I want to emphasize that this is for qualified business stock small business stock that was issued after the July 4th, 2025 period. So we kind of have we have a bunch of different things to look at when you have small business stock and that's sold and you have a gain, to look at when was it issued to determine what the exclusion could be. But again, as part of OBA, if it was issued after this time period, you have the tiers of, if it was held 3+ years, 50% of capital gains can be excluded, held 4+ years, 75%, and held 5 or more years, 100% of the capital gains can be excluded. So kind of beneficial here that, if you're not holding it full 5 years, you don't just lose out on the whole, all of the gain exclusion. You could get something, whether it's 50 or 75%. What also changed as part of that with the small business stock that was issued after July 4th, 2025 is to increase that per issuer cap to be $15 million instead of $10 million. And the maximum gross assets corporation can have to qualify to be small business is increased from 75 million from 50 million. And these items are also indexed for inflation. Part of what OBA had was the elimination or phase out of a bunch of the clean energy incentives that had been part of previous acts and bills that have been passed prior to OBA. So we have here a list of a lot of the different clean energy incentives, the code sections, the names, the termination dates. Just a few to highlight. Looking at the first 3 are all related kind of to the EV credits and the other clean energy vehicles that had qualified. So those had terminated. The credit had terminated after the September 30th, 2025 period. So anything acquired prior to that, the credit was applicable, but after that is now gone. The some other ones that we see more often, the 25C, 25D being the energy efficient home improvement credit, residential clean energy credit. So think about on personal tax returns, some of the home improvement credits for buying energy efficient, heat pump, HVAC unit, the doors and windows, those types of things that, the credits were small, but they could add up. Those are going away after December 31st, 2025. So if there's anything, looking at before the end of this year, if it qualifies for the credit, you might want to look at, purchasing now, putting in service now, rather than next year, just from a standpoint of the credit won't be available. The 179D, what we see for some businesses, that is subject to go away, starting for a property that construction begins after June 30th, 2026. So just keeping in mind for businesses that may be doing something in the realm of energy efficient commercial buildings that qualify for that deduction. And then the 45L new energy efficient home credit we see for home builders sometimes. That one also is subject to go away after June 30th, 2026. The employer provided childcare credit, not something to see a lot, but definitely is interesting if it is something that a business employer is doing. There was a pretty significant change here. So under TCJA, that had instituted an employer provided child care credit up to of 25% of qualified child care facility costs with a maximum annual credit of $150,000. What OBA did was it increased that credit to 40% with a maximum annual credit of $500,000, and then also added for eligible small businesses that those would be subject to higher credits, so 50% and a $600,000 cap there. This is effective for 2026. And just to kind of give a little background of what qualified childcare expenditures include, there's kind of three prongs, one being cost to acquire, construct, rehab, or expand property that's used as the taxpayer's childcare facility. Second being operating expenditures of a childcare facility that are made by the taxpayer to support those childcare activities. And then third being amounts paid under a contract with a childcare facility to provide childcare services to employees of the taxpayer. So a couple different things that could qualify under that. Paid family and medical leave credit. So the TCJA had allowed an employer credit of between 12.5% to 25% of wages paid to employees on family and medical leave through 2025. So OBA made this credit permanent. So with it being set to sunset after 2025, OBA has got rid of the sunset, made it permanent. And the other piece that was included through OBA was an option to calculate the credit instead of just using calculating it based upon wages. You could still calculate it that way, or use a percentage of the premiums paid for the family and medical leave insurance instead of those wages. So corporate charitable deductions, just to be clear, when we talk about this is just for C corporations. So pass-throughs is going to fall under what we had talked about a little bit earlier this morning with the individual changes. But for C corporations, there are a couple changes. One change that's being made to the C Corp charitable deduction. So under older rules, which apply still for 2025, what we've always had is a deduction limit of 10% of taxable income. So basically anything above that 10% limitation would be carried forward up to 5 years. There was no floor, but now part of OBA, just like we talked about with individuals, is adding a floor to that equation. So it's now a 1% floor. So you can't get a deduction until you exceed 1% of taxable income. Anything below that 1% of taxable income, those charitable contributions are not deductible. And then we still have the 10% ceiling limit as well. So essentially, what you're getting, if you can deduct, if you have enough charitable contributions, basically you're at 9% essentially that you could deduct of taxable income. So just kind of as an example of this floor and ceiling, if we had $1 million taxable income for the C corporation, the first 1%, so 10,000 of charitable contributions would not be deductible. Our ceiling being 100,000. So if we had more than 100,000 of charitable contributions, we'd only be able to deduct 90,000, and any excess above that 100,000 would be carried forward for 5 years. So kind of the note here being that amounts that are below the floor, that are not deductible are permanently lost unless the corporation exceeds the 10% ceiling. So in those cases, the amount of the floor would carry forward, but again, be subject to the floor in future years as well. One of the other items included was kind of a small detail, but with the K2, K3s, which are have been added in the last several years for pass-through businesses, S corporations, partnerships have this schedule to report some foreign activity. They had added another exception to having to file those schedules, and you need to meet all the criteria. So being gross receipts for the year are less than 250,000, assets at the end of the year are less than $1 million. The K1s are furnished to the partners timely, and the entity is not required to file Schedule M3. So we have another polling question. What business tax provision is most relevant to you? And it looks like we have 35% restored bonus depreciation, 33% QBI made permanent, and 22% say other. Just a few other miscellaneous provisions that were part of OBA, just to keep in mind. The Form 1099-K reporting, that has reverted back to thresholds of $20,000 and 200 transactions. That was set to be much lower and subjecting a lot of people to the reporting and receiving those 1099-Ks. So I think a much relief in that was reverted back to the higher limitations. The 1099 miscellaneous and NEC forms. So in 2025, we still have our normal $600 threshold for payments that need to be included in those types of reportings. But for after 2025, for the first time in a very long time, that amount is increased into $2,000 and will be subject to annual inflation adjustments starting in 2027. So I know that'll probably be a hard thing to keep in mind and remember, but will be maybe some less reporting of 1099 miscellaneouses and NECs instead of having to be subject to a very low threshold of $600. The employee retention credit, there was a little bit of a piece within OBA that was in there. There's a lot of stuff related to fraudulent claims and those types of things. But the one thing we wanted to point out was that it did retroactively invalidate claims that were filed after January 31st, 2024 for the third and fourth quarters of 2021. So anything though that was, if the claim was filed prior to that date, anything that was part of OBA did not invalidate those timely filed claims, but just wanted to point out that if anybody had filed something after that period for that third and fourth quarter, that it will not be refunded because it was invalidated as part of OBA. And then just wanted to kind of reiterate some of the other things that, what are we looking for next coming out of, what's been, there's been some regulations or some guidance that has been issued, but there's a lot more expected to come over the next several months to a year plus, because some of the things that we talked about, some of it was for 2025, but some of that was just things that were already in place and didn't really change. But there's a lot of things in 26 that are some big changes that we don't really have all the guidance yet for. And how do you how do you report, how do you implement some of these other things. So we do expect a lot more guidance to be coming yet. Just some of the things that was included in there was the that had been announced previously or a little bit earlier this year was the W-2s, 1099s, 941, other payroll returns would not be changing for the 2025 tax year, like we talked about, that the federal income tax withholding tables, they weren't going to be updated by the IRS for 2025, and just some of the other procedures that we talked about for the overtime and the tips reporting, that they have provided some guidance on that and are continuing to provide it. As we'll talk a little bit later this morning, one of the things is, well, how are the states adapting to some of these OBA provisions? And we have some Pennsylvania, Maryland, we know some of that, some of the surrounding states. But it's going to kind of come in here or there as states start passing budgets, start passing different legislation of how they're going to either adopt or they're not going to adopt, or they're going to decouple from some of these provisions. We've already seen in some situations it's picking and choosing of what provisions they are going to follow and what they aren't. Some of the states using it as a way to balance the budget, to have additional tax revenues. So just that's one of the next things kind of to keep in mind of how the states are going to take them, and you're going to have all across the board a lot of different methodologies of following the new rules, not following the new rules, and still following pre-OBA provisions for 163J, bonus depreciation, things like that. And as we talk about 174 with Pat, a lot of those are really interesting how the states are following or not following. And with that, we will go to Q&A.
I'm actually not seeing any business tax update questions at this time, so we're good to keep going.
All right. We'll move to Mary Kay. We'll be talking about reasonable compensation.
So good morning, everyone. We're going to look at reasonable compensation in S corporations this morning. And I thought this was an important topic to review because in my 35 plus years of practice, this is probably the #1 question I've received from my S corporation clients. How much can I take in S distributions and how low can I keep my salary? So reasonable compensation also applies to C corporations, but we're focusing on S corporations this morning. And a side note here is that in the United States, S corporations are more prevalent than C corporations. The most recent statistics show that there are over 5 million S corporations versus around 2 million C corporations here in the US. So what is reasonable compensation? The IRS definition is the value that would ordinarily be paid for like services by like enterprises under like circumstances. Now, that's not a very clear definition. So to give it a little more context, reasonable compensation is determined by facts and circumstances. And it's important to note that the taxpayer bears the burden of proof to substantiate reasonable compensation. But before I expand more on that, I want to give you some common misconceptions about how reasonable compensation is determined. Some say you can do 50% wages, 50% distributions. You might hear you can do the Social Security wage max, which currently is $176,100. You might also hear setting wages as a percentage of sales based on industry standards is acceptable. Well, unfortunately, none of these would satisfy the IRS if you were under audit. And part of the problem is that there's a lot of misinformation out there on the internet, So remember, Google is not always our friend, especially for tax advice or when dealing with the IRS. So one of the easiest way to think about reasonable compensation is, what is the fair market value of the services that you provide? In other words, if you were going to hire someone to replace you in your business, what would you pay that person? Now, it's not what you would want to pay, but what would you have to pay to attract that person to work in your business? So let's take another step back and ask, why do S corporation owners want to take a low salary and higher distributions? And the simple answer is payroll taxes. Salary is subject to all payroll taxes, and distributions from an S corporation are not. This fact is a huge benefit of having a business that is taxed as an S corporation, so you can't blame the owner for thinking that way. The problem is it gets abused, and the IRS is onto it. The 1120S, which is the S corporation tax return, for those of you that don't know, those instructions specifically state that distributions and other payments by an S corporation to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services rendered to the corporation. Sorry about that. So another interesting fact is, when you receive the letter from the IRS that says your company has been accepted as an S corporation, it specifically states the following. You must determine a reasonable salary when the shareholder employee provides services to the corporation. Payments to a shareholder employee for services to an S corporation are wages subject to employment taxes. And the most impactful statement to me is the following. We may recharacterize distributions paid to a shareholder as salary if the distribution was paid in lieu of reasonable compensation. So we have another polling question here. This is a true or false. The taxpayer bears the burden of proof to substantiate reasonable compensation. Okay, that is true. So most of you did get that right. So glad you're listening this morning. So now let's take a look at some factors in determining reasonable compensation. The first would be training and/or experience. Now this would be in, having like a college degree or some type of special training that may be required for your position. Duties and responsibilities, that's pretty self-explanatory. There's time and effort devoted to the business. Is it a 40-hour work week, 20 hours, 60 hours? So how much time do you spend working in your business? There's dividend history. Now, this would be more related to a C corporation as opposed to an S corporation, although I do believe the IRS would look at S distribution history if you've been in business for several years. There's payments to non-shareholder employees. So here they may be looking at your employees and are they making more than you, which would probably be a red flag that you weren't paying yourself enough. Also, time and manner of paying bonuses to key people, what comparable businesses pay for similar services. There's compensation agreements, and this may be applicable if there's like a board of directors that you negotiate a salary with to prove that you are at an arm's length or that you have an arm's length agreement in place. And last would be some type of formula used to determine compensation. So to sum these factors up, you could look at the first three bullets as like the major players and the last six as maybe helpful to the cause of documenting the reasonable compensation amount. Sorry, why does that keep going ahead? So now we're going to look at a recent court case, and the reason this court case is considered very helpful is because it gives us insight on how the IRS determined reasonable compensation, but it also gives us insight on how the court determined reasonable compensation. So the company was McAlry Ltd. The owner's name is Sean McAlry, and he was a realtor in California. And he was being audited for the 2006 tax year. So that year he reported net income of $231,454. His shareholder distribution were $240,000, and his wages were $0. So right from the get-go, we know why Mr. McAlry got flagged for an audit. There's really no rocket science here. He took no wages and all less distributions. But before we get further into the court case, let's look at the tax savings he had by taking the distributions instead of wages. So in 2006, the Social Security wage max was $94,200. So at 6.2%, which is the Social Security piece, that's a savings of $5,840. And then you take that times 2 because you have the employee side and the employer side. So that gave us a total of $11,680. You also have the Medicare piece of 1.45%, and there is no max wage. So you take the entire $240,000 times 1.45% times 2 for the company piece, and that comes to $6,960. So although I'm not familiar with California taxes, I'm sure there was California unemployment, probably other local taxes that he did not pay by doing this. So he most likely saved in excess of $20,000 by not taking any wages. So let's see here, go to the next slide. The IRS came up with $100,775 as reasonable wages. So what they said was Sean's primary job function was a real estate agent. He worked full-time, including 12-hour days, 6 to 7 days per week. They compared company performance with his peers in the real estate industry. So they determined the fair market value or replacement cost was $48.44 an hour. So if you take full-time hours per year, that's $2,080 times the $48.44 an hour. That's where they came up with the $100,775 per year. Mr. McAlry said his wages should be $24,000. Now he said this during the audit, obviously because he took no wages, but he said there was a miscommunication with his tax preparer, and that he should have paid himself $24,000. And he also stated that it was memorialized in a compensation agreement and documented in his corporate minutes. Now we see why the IRS wouldn't go for this, because Mr. McAlry was the sole shareholder in the corporation. So even though it was in his corporate minutes, there was no arm's length negotiation here. He made the agreement with himself. So that wasn't going to fly. The IRS obviously didn't agree, so they went to court. So here's what the court came up with. They said his wages should be $83,200. They took into consideration all the services he provided, including management, supervision, recruiting, bookkeeping, advertising, in addition to just being a realtor. They also took into consideration that he was relatively new to the industry, so he didn't have a lot of experience. The court also published or looked at published wage data in California and came up with a range of $33 per hour to $64 per hour for all the services he provided. And they came to an average of about $40 per hour. So if you take the 2,080 hours at the $40 per hour, that's where you get the $83,200. The court also stated that determining an employee's reasonable compensation is dependent upon a number of factors and is far from an exact science. There's a number of court rulings out there now, in addition to the McAlry case, that you can reference if you're trying to determine reasonable compensation. I do want to state here that it's also interesting that two of the court cases out there are CPA firms. One is David E. Watson, and another is JD and Associates. So here we have CPAs that were not paying themselves reasonable compensation. So you can see where a lot of the misinformation is coming from. We have another polling question. So true or false, the IRS is only concerned about reasonable compensation for S corporations and not C corporations. Okay, so the correct answer is false. It is applicable to C corporations as well. We did not go into that this morning, but I did state that in the beginning that it's important to both. I'm not sure if we have any questions.
I do have one question for you, Mary Kay.
Okay.
If reasonable compensation would create a loss for the business, can a lower amount be paid that does not create a loss?
That is really not a factor. I can see why somebody would think that, but it really centers around the factors that I went over: the training experience, how much time spent in the business. You could make the argument, but you know, it's in my opinion, it is not a factor. Now, I mean, of course, you wouldn't want to say something like, all right, $250,000 in salary, you know, gives me $150,000 loss. You know, I think there's some reasonableness you can apply in that area, but no, you really have to focus on the factors that I mentioned in the previous slides.
Perfect. And then one more question did just come in as well. If bonuses are paid to the highest paid employee, and that is what the reasonable compensation is based off of, should the owner also receive the same bonus?
No, the owner doesn't have to receive the same bonus. Reasonable compensation for an owner is based on what they do, their training, their time in the business. I mean, you could certainly, you know, if you have an employee that went above and beyond, or there's some kind of sales bonus for the employee, non-shareholder, that could certainly be legitimate. The reasonableness of your compensation would focus on what you do in the business. I mean, I think what I was referring to before is, you know, if you had mostly salaried employees and you're salarying yourself at 50,000 and most of your employees or your management level employees are at 100,000, you know, that could be looked at as you should be closer to the 100,000, but not bonuses for, you know, that were earned.
Perfect. Thank you, Mary Kay. That is all the questions we have right now.
All right, everybody, it's 10:25. Are we good to go, Kayla?
We are good to go, Pat.
All right, perfect. Well, good morning, everyone. I'm Patrick Rogers, the Tax Principal and R&D Director here at Brown Plus. Today I'll walk you through the 2025 R&D update. What's changing federally, how Section 174A resets rules for domestic R&D. Retroactive relief we'll go over what that looks like for small businesses, and conformity when it comes to Pennsylvania. And then we'll close with some practical next steps as well as a Q&A. So for the agenda, we have a number of things. Obviously, it's a transition year. So for R&D purposes, a lot of changes have come down. Section 174, recovery of capitalized R&D from the 2022 and 2022 through 2024 timing. What that looks like for conformity changes federally for Section 41, which is the credit, and then 280C, which is the election when you claim it, whether it's reduced election or if you take the gross credit. Pennsylvania treatment, we'll touch on that for obviously R&D. The bill was just passed, as we talked about a little bit in the earlier presentation, and how that affects C corporations as well as the pass-through entities. And then obviously next steps and taxpayer considerations. So at a high level, OBA reversed the Tax Cut and Jobs Act mandatory capitalization for domestic. And obviously for the new law, the Section 174A, which is restoring the immediate deductibility for domestic R&D. It offers future treatment as well as limited, I would call, retroactive relief for small businesses. So it, amends the Sections 141, which is the credit, 41D specifically, and 280C, which is the election piece. So the big news once it was signed in July was R&D is immediately expensed, and then while foreign piece, so the non-US, the international costs, are not fully deductible. So keep that in mind, and let's work on that obviously when we plan. Skip a little bit there. I'll note, I'm sure it's delayed for you, but it's a little touchy on this side. So as we mentioned, really the main piece for R&D and domestic piece. So effective January 1, 2025, domestic R&D costs are fully deductible. No more mandatory amortization for that domestic spend. Foreign research remains subject to the 15-year amortization requirement. There is the option, to do the 60-month, which is a 5-year amortization if it's best for financial purposes. Again, it's facts and circumstances, obviously, keep that in mind for planning. It's not all, most folks like to take the deduction right away, but it does have the option that you can still use the amortization 5-year if it makes the most sense. There's flexibility for the unamortized Section 174 costs. So this was the biggest takeaway. So for deduction, you can take them fully. So the unamortized costs I'm referring to were 2020 through 2024 if you capitalize them over that 5-year requirement. So you have the ability to take all, like a super deduction, in 2025, or spread them over both 2025 and 2026 equally. So the important there is, retroactive for small businesses, and we'll touch on the eligibility and the deadline for that shortly. So essentially, keep in mind that it's really domestic. The foreign piece still has to obviously be at 15 years. So there's no retroactive relief for the international costs that were subject to the 174 requirement. So as I mentioned, the touch point of when it occurs. So the deadline is July 6th if you want to go back and do the small business recovery. So small businesses are classified as an average gross receipts of $31 million or less. So therefore, the opportunities you could amend 2022, 2023, and 2024 returns if you didn't take in 2024, if you didn't capitalize it. For some of the taxpayers that we were able to get in front of earlier, you were able to deduct your 2024 R&D costs because essentially OBA was signed in July. So to claim the full deductions for domestic, deadline amending returns is July 6th, which is 1 year after it was signed. It doesn't mean you have to amend all, so you could look at each. So 2022, you could amend that and obviously not touch 23, but the best course of action is if you have them and you're able to obviously look at it and say, let's get the deductibility, or if you wanted to just look at it and say, the lesser of the two administrative burdens, going back and filing tax returns, you could essentially, take all in 2025 in that one shot, or go over 2 years, equally 2025 and 2026. So the flexibility there is huge because you could coordinate treatment of R&D credits with essentially estimated tax payments made or to be made, especially if you go back and recharacterize prior year expenses. So this is helpful with when you want to file it, if you're amending a return, if anybody's ever done that, keep in mind, it is a timely process from the IRS side, not obviously from the tax accounting side, but essentially it's not a, hey, here's my return, we're done, move past it. It is subject to the standard IRS treatment of a number of months. So clearly, to identify as a small business, look at your gross receipt history, and then obviously look at your domestic R&D pools by year. Documentation readiness is key there for amended filings. Okay, with that, we have our first polling question. So with OBA, the R&D deductibility change, which option would you prefer? Obviously, there's a number there, but we touched on just real quickly amending, take all in 2025, take evenly, we're just unsure, let's the last prompt. So 50% obviously wants to review with the CPA to determine. That's fair. Low percentage of that amended 2022 to 2024. That's okay too, because again, most people think amending the return, they'll get audited. Actually not the case. Really, it only increases your audit from 1% of a timely file return to roughly about 5%. And with the low amount of folks at the IRS currently, I wouldn't be too worried or cognizant to say that this is putting your hand up for an audit. Okay, what costs qualify for the credit? So to be credit eligible, so the costs are primarily your folks, your employees, and they're effectively directly involved, meaning they're the ones doing the R&D activities. It could be the project managers, so the folks that are also involved, like the first line supervisors. So number one is obviously your people. The supply costs are key because you use, consume, or kind of destroy in that prototyping phase where you're reaching that optimal solution, but you're not quite there yet. So those costs do qualify as well. Contract research and obviously certain computer leasing costs. Keep in mind, this is all US spend. So I know some folks spend a number on contractors or might have employees overseas. Really, it's a US credit. So we just want to clarify that it is US centric boots on the ground test. So if you have folks, developers overseas, unfortunately, those costs would be parsed out for R&D credit purposes and also be subject to that international 15-year requirement to amortize it. So ultimately, think about centers where you have product or process development, not general overhead. So cost centers, essentially, a lot of the bigger firms have software developers in cost centers of those pools, essentially. One key thing there with the contract research is the US functionality is the IRS has a haircut to that. So you're only able to take 65% of those costs. Really, it's a jobs credit. So the IRS looks at it and says they want to reward companies, using their own staff, their employees for R&D purposes. If you use outside consultants, that's okay. They do give a 65% of that cost. So they don't give you all 100% like they do for wages. The R&D qualification criteria is really the 4-part test. And if you're a software developer or do your own internal use software, it's actually a 7-part test. But I won't bore you with all 7. So we'll keep you with just the basics of 4 parts. Obviously, permitted purpose. There is essentially a new and improved product or process. And keep in mind, it's new to you. It doesn't have to be new to the world. So you don't have to have the one of one or the one and only that's out there in the world. So you're building software yourself, improving the framework, evaluating opportunities or evaluations and testing it. That would be a perfect example of a permitted purpose. Technological nature is another one that's a big prong that it's got to be the hard sciences, engineering, physics, chemistry, biology, and computer science, obviously. So next 2 are kind of hand in hand. Elimination of uncertainty and process experimentation. So essentially what that's telling you is you have to be a little more cognizant of if it's one and done and you did it in one shot, chances are it's not R&D, but if you spent the time, energy, multiple iterations, experimenting and saying, well, this didn't work, or this worked to an extent, we want to add more functionality or ability to kind of be more, perform better. Those are some of the key examples of the 4-part test. With that, we have another polling question. So true or false, 50-50 chance here. Project expenses must undergo the 4-part test to determine whether the R&D claim meets the qualifying standard for approval. All right. 96 on the return, or 96 on the test is pretty good, everybody. So that is true. False may be those folks that are doing that computer software that think about that 7-part test, but well done. That's true. All right, so next we're going to work through the conforming changes for 41, which is the credit, and 280C. So really under OBA, if you claim the gross credit, which is essentially what you've done if you work with us, obviously that was the best bang for the buck, the gross credit. So under OBA, if you claim the gross credit, you actually have to now reduce. So you must reduce the domestic R&D expenses by the amount of that credit. So ultimately, you're not looking at saying, I'm going to amortize these costs anymore. I'm going to essentially take a reduced credit, which gives you the ability, you're basically taking 79% of your R&D credit. So under OBA, the 280C is now conformed or changed to essentially go back to the way it was. They're pretty consistent with the pre-Tax Cut and Jobs Act of 280C. And that's including, so 280C, if you're not familiar with it, it's an election made on a timely filed return, and that is including extensions that essentially, does not have an add back requirement for the credit. Also, 41 is now adding another subsection of the tax code. 41D now requires that expenditures be treated as domestic R&D under 174A to count as qualified research for the credit. So that essentially tightens the connection between expensing eligibility and credit qualification. So obviously, when we work up or work with clients that are doing the R&D, we look at both methods, gross credit with the expense reduction, or do we take the reduced credit election? So that helps us kind of path and prove out for tax purposes, what's your effective tax rate? How does that look for financial statement preparation? So essentially that goes a long way in helping you determine, what's the best course of action when claiming the credit and claiming either 280C or the reduction, or 280C with the reduction or the gross credit. Okay, so with the tax bill that just passed, I say just passed, but that was last month with Pennsylvania. This is effective beginning after 12/31, so right in the same time frame for tax purposes for 2025. So Pennsylvania treatment, C Corps and pass-throughs. So C Corps, the entities that are subject to the corporate net income tax, in Pennsylvania, they do not fully conform to the Internal Revenue Code 174 or 174A. So what does that mean? C Corps must add back the federal amortization and depreciation for R&D, qualified production property, but it does allow an additional 20% remaining unamortized qualified R&D costs annually until the full federal amount is claimed. So essentially, this passing of the tax bill really is only C Corp centric. So really, you're still in that conformity issue where 174 is a problem, meaning you have to add back those expenditures and amortize them. So yet for federal purposes, that resolves that issue that's been going on from 2022 onward. But as a C Corp in Pennsylvania, you're still up to that discretion where you are required to add back. Pass-through entities, obviously for partnerships, S Corps, LLCs taxed as a personal income tax. R&D expense flow through as an ordinary income, so there's no special PA add back, or there's no special additional deduction beyond this rule. So really, it's a non-issue when it comes to the pass-through entities for the conformity and non-conformity here. Let me just go back on that slide real quick. I just had one thing. So it really creates an issue when you have federal as well as PA tracking, similar with the depreciation, but it's helpful to build out whether it's a template or something where a PA ledger that isolates the add back and it includes that 20% deduction cadence, because that's such a new thing that some providers might miss that. So make sure, again, for PA purposes, you're a C Corp, you want to have 2 looks at it. So obviously for federal purposes, you're deducting it. And then for PA, you're unable to, but keep in mind, you do have a 20% deduction as well. So that's something that's in addition that is not relatively common, that now is new, that you might want to track that one yourself. All right, summary, next steps. So obviously the big one is immediate expensing for the domestic R&D under 174A. Foreign R&D is still amortized. Retroactive relief exists for small businesses, which is that $31 million gross receipts and below. They can amend 2022 through 2024 to claim full immediate R&D deductions and potentially recover deferred expenses as well. So reviewing accounting method changes and evaluate amended return potential as well are key in the next steps. That leads us to polling question number 11. Has your company evaluated the impact of the R&D deductibility changes and how to best align with your tax planning goals? All right, it's a pretty split decision. So 58% yes, 42% no. And forgive me if you can see the same results I see, but I always think it's interesting how that plays out in some of these polling questions. All right, so next steps continued. Documentation is key, and that doesn't mean you have to have it yourself, but there's a little bit more complexity for the IRS in addition to qualified expenses, the activities, and what the IRS determines what's a very fancy word called business components, but really that's just what are your new and improved products, processes. So from that point of view, the documentation and the complexity of what the IRS is looking for, we essentially want to make sure you're aware of all these common pitfalls that folks that think they have, pretty buttoned up documentation. However, if it's ever under audit, the IRS look at it and say, well, I don't see a clear distinction amongst business component X to business component Y. So really tightening that up is key. One of the bigger ones I see is the stricter wage classification. So I've seen a lot, been around a lot with the IRS and even the state levels, that direct R&D and the supervisory roles and supporting staff. If R&D is there, sometimes the burden, understanding what your team does in, the project management role for the indirect technical, sometimes that's challenged, and right away that's one that is helpful to kind of build that out and ensure you have it for sure. The scrutiny is there, as I mentioned, the compliance with these issues, mistakes could lead to claim delays or lost credits. So again, what you do could 100% qualify, but if it's not documented properly, or that distinction between what's a business component from the start or non-business component, it just has to be, again, the IRS has to understand your business, what these are, and essentially, we need to clarify, these new sections that are coming out, and that meant, section G, which actually that changed, meaning that it was optional in 2024, tax year 24, became mandatory in 25. However, they changed it again because just the level of magnitude that creates within the industry. Section G, that I'll save you the time from looking it up, but the R&D tax form 6765 essentially built out Schedule G that laid out the taxpayer had to provide their business components, who operated in what, and have the costs essentially bifurcated out of, who did what in every category. So that's mandatory in 2026, tax year 26, which is coming shortly. Obviously, it's hard to believe, here we are right in the end of 2025, but tax year 26 will be here before we know it as well. I'll turn it over to Q&A, but I just wanted to say before that, as the questions do come in, a quick checklist to help, segment between what's domestic, what's foreign, decide on expensing or doing the 60-month, which is a 5-year R&D amortization.
Perfect. So Pat, I do have one question at this time, which is, can you deduct patent costs that were previously amortized in 2024?
That's a great question, and that's one that has specifics that sometimes patent costs, if it's protective patent or if it's ultimate patent, you have to look at that layer. So the chances are it depends in the traditional accounting session here. That was one I'd want to look at the specifics of saying a yes, no, but there's some catches in there with the protective patent, with a regular patent, a regulatory patent. But yeah, typically we want to look at those costs, and if you already amortized them in the past, say it's not a protective patent and it's essentially you're patenting your idea, you would have the ability to deduct that. That is Section 174 qualified, but you want to be careful for Section 41, which is the credit, to essentially look at that, including that for credit purposes.
Perfect. And that is the only R&D question I'm seeing at this time, Pat.
Okay, thank you, everybody.
So my name is Jason Skrinak. I'm the founder of Pivot Strategic Consulting. And over the next 30 minutes or so, I want to go over a brief review as to where we're at with regards to Pennsylvania, give you some updates, give you some things that I'm seeing, give you a kind of a laydown as to where we were, where we are, and where we're going here in PA. You'll see here the agenda, go through the budget, go into some corporate tax updates, sales and use tax updates, and take a look at where Pennsylvania is currently ranked among other states under the Tax Foundation report. Very brief review of business privilege tax, and go over some current sales and use tax audit issues I'm seeing that I think are pretty important for you to understand. And then briefly go over some multi-state tax updates. So the budget was supposed to be completed by June 30th of this year. As most of you are aware, that was not the case. The proposed budget that came out in March this year was providing for a budget spend of probably, it was about $50 billion or so, $51 billion. Last year's budget, 24-25, the spend was $47.6 billion. So significant increase. The original budget that was being proposed by the governor provided for some revenue raisers, specifically the legalization and taxation of recreational marijuana. You'll see many states around us, the surrounding states, have already passed that. So Pennsylvania was looking at, they already have their residents going into other states to make these types of purchases in some instances. So they were losing tax dollars. But this was a rather tenuous issue. No one was really super behind it. So there was very little chance that I thought that that was going to go through. There is another area with regards to the taxation as games of skill, which I think is kind of a misnomer. I think there's very little skill with revolving around these video game monitors that you kind of spin the wheel and try to get some winnings out of the machine. The big contention was from the casinos. The casinos were pushing for Pennsylvania to treat these machines, the game of skill machines that you see in various convenience stores and establishments. They're looking to have these games taxed similar to what the casinos are being taxed. I was kind of floored when I started looking into this. The casino games, they're being taxed at 52% tax rate. Pretty staggering. The tax on the game of skills currently is was about 16%. At the end of the day, neither one of these items really got much legs behind them, so nothing was really brought forth on these two issues with the current budget. The big expenditure items were associated with education and human services, as you can expect. So there was a lot of back and forth between the House, the Senate, the Republicans, and the Democrats. But on November 12th of this year, the budget was passed. And the budget was passed at $50.1 billion. And kind of surprisingly, the budget was passed without any additional tax revenues associated with it. It's kind of a little game of, you know, the Monty game, the two-hand Monty. They kind of moved some funds around that were available. There are some surplus funds from last year's budget that were not used, that were used to try to help offset this. One of the surplus items from last year is kind of funny. There was a lot of money being set aside. There was a big concern last year that the avian flu was going to have a large impact on the Pennsylvania economy. So they had some funds set aside for that. Thank goodness it never came about. So these funds were available, and some other funds that had some excess funding as well were used to provide for the offset in the budget, where they were able to fund the budget without any additional taxes. The one area that they did not take money from, which I'm really glad that they did not, was Pennsylvania's rainy day fund. In the past, during budget seasons, right, that rainy day fund, it's supposed to be used for extraordinary events, hence the name rainy day, emergency usage. And in the past, this was used basically just to be able to bridge the gap in the budget between what they were trying to spend and the revenues that they had available to them. Recently, past several years, that rainy day fund has not been used, and actually we've been putting money, stocking money into that rainy day fund. So that's great, and we'll kind of go into why that's important in the near future. Some of the highlights of the budget with regards to taxation is the decoupling from the various portions of the One Big Beautiful Bill Act that was previously discussed. Pennsylvania was looking at potentially losing several billions of dollars with regards to these federal tax cuts. So they had no stomach to follow suit with regards to the federal act. So what we have here is for the IRC 174, the research and experimental, Pennsylvania is now adding back any of those deductions for 2025 that were made at the federal level. They're adding those back for Pennsylvania purposes. In addition, they will allow the use of that add back over a 5-year period. So whatever is added back, you divide it by 5, so you can use that 20% of the add back for the next 5 years. Part of what I am involved with is part of the Pennsylvania Institute of CPAs, and we meet with the legislators a lot to go over concerns over tax issues, concerns from the practitioner, concerns from, you know, taxpayers themselves. And we were not really brought up to speed on what Pennsylvania was proposing with regards to this add back. And there's some potential concerns that PICPA is working with the Department of Revenue and the legislators to make sure that they understand the wordings that they have in the statute and the repercussions that it has. So basically, you'll see here that, you know, any 174 deductions taken for federal purposes in 2025 is added back, and you know, talked about it before. You use it over a 5-year period. However, if you are not filing a Pennsylvania return, you can never add back, you know, you can never make use of that IRC 174 deduction. So if you have any taxpayers out there that are, on the verge of, having Pennsylvania filing requirements, or they've had filing requirements and never made those filings in the past, you want to consider filing for 2025. Because if you don't for 2025 and you don't add back that IRC 174 expense, you'll never be able to use those expenses going forward. So something to think about, something we're trying to work with the Department of Revenue and the legislators to make sure they understand the impact of that, and making sure that that's not what their intent was. So hopefully we'll work through and get a better feel for, what does Pennsylvania truly want from this, and is this something that needs to be addressed going forward. The next two, the qualified production depreciation and the business interest expense, Pennsylvania is saying, hey, look, we're not following this. For Pennsylvania purposes, you have to add back anything that was deducted for federal purposes and use your own separate Pennsylvania calculation, as if the one big beautiful bill was never enacted. So those are two main items that you should be concerned about, making sure that you follow that for Pennsylvania. The Department of Revenue is working on providing more guidance, and that guidance should be coming out shortly, I would hope, to provide how they want to have this 168N and 163J, how they want these to be calculated for Pennsylvania purposes. Another item that was in Pennsylvania's budget is the creation of the Working Pennsylvanians Tax Credit. They are providing that it's up to 10% of the federal earned income tax credit you can now take for Pennsylvania purposes. And that's effective for this year, 2025. Another nice thing is that it's actually a refundable credit. So things to keep in the back of your mind. Pennsylvania was looking at possibly expediting the reduction of their corporate net income tax, right? So for years, Pennsylvania was getting a black eye across the country with regards to having a 9.99% corporate net income tax rate. To offset that, Pennsylvania decided, hey, look, we're going to start phasing down the corporate tax rate. That 9.99% was not competitive across the country, and Pennsylvania is looking to address this by taking the tax rate from 9.99 and moving it down to 4.99%. For 2025, the tax rate for corporate net income tax is 7.99%, and then we'll have an additional 0.5% reduction through 2023, at what point in time it will be a 4.99%. I just realized, I apologize, on this slide it says 2023, 4.99%, 2033 is the actual date. Some initial comments with regards to the budget and what Pennsylvania Department of Revenue is looking at and how they are applying the federal tax changes. They can be found at this link, provided the PICPA. It was a Pennsylvania Department of Revenue reply to various questions and concerns that we had. Another area of the Pennsylvania budget that's kind of interesting is the Child Care Retention and Recruitment Credit. That is a very hot topic here in PA. They want to make sure Pennsylvania workers actually have good child care available to them. And as part of that, they're looking to make sure that the workers in this industry, they stay in the industry, or they attract and recruit more people. So there's a child care retention and recruitment credit available. Another thing with the budget is some spending of $50 million set aside for special events coming this year. I think this is going to be money well spent by Pennsylvania. You can see here that the events that they're scheduled for is the America's 250-year birthday, the World Cup being held here in Pennsylvania, or some parts of the World Cup being held here in PA, the NFL draft coming to Pittsburgh, Pennsylvania, and the Major League Baseball All-Star Game. So I really think that those are going to be huge revenue raisers and things that you know, that $50 million spend, I think they're going to get back several fold. So taking a step back and saying, hey, look, what was being proposed that was not included in this budget? Usually you see if something's not included in the original budget that they're talking about, we'll have to probably address this at some point down the road, and usually it pops its head up again. So combined reporting. Pennsylvania keeps considering combined reporting for corporate net income tax purposes. I'm not sure the true rationale behind it. So combined reporting, Pennsylvania is a separate company state with regards to corporate net income tax. That being said, each separate entity files and prepares their separate Pennsylvania corporate net income tax. Going to combined reporting is kind of taking affiliated entities and grouping them and having one tax filing that covers multiple entities. With regards to any tax legislation, there's going to be winners and losers. So I really don't have a strong say either way. You know, if we want to stay a single filing state, that's fine. If we want to go to combined filing, that's fine as well. My concern is that Pennsylvania is kind of viewing the transition to a combined filing as a revenue raiser. And I'm not quite sure if they truly understand that, you know, possibly it could create some additional tax revenues in PA, but not in the short term, right? So tax practitioners like myself, businesses out there, taxpayers themselves are going to take a look at, if they go to combined reporting, they're going to be making filing positions that are in the best interest of their needs. And usually the best interest is paying, you know, less tax than what you have to, or what Pennsylvania would want from you. So under a combined filing, there's a unitary group of filers within that combined report. So the thought process I have is there's arguments as to who is included and who is excluded from that unitary group of filers. And usually you're going to take a position that will benefit you for Pennsylvania purposes, right? So say I take a position that my client is going to exclude certain high revenue entities from the Pennsylvania report, saying, hey, look, they're separate. They are truly not a unitary group for whatever reason, you know, different types of ownership, different industry. There's many different reasons as to why they may not be deemed to be part of the unitary group. While excluding those entities would make your Pennsylvania tax liability less. Once Pennsylvania gets the return, I'm sure they'll look at it at a different perspective. So say we file a return saying, you know, there's $100,000 of corporate net income tax here in PA. Pennsylvania takes a look at it and they say, no, we think this is more 200,000. We want to include companies A, B, and C in the combined report that you did not include. Well, guess what? That $100,000, probably you're going to appeal that. And, you know, the appeal process in Pennsylvania, we'll talk about in a little bit, takes a long time to get through. So that time value of money, right? Pennsylvania is not going to get that $100,000 additional tax that they're expecting. If they're successful, they won't get that for several years. So I just hope that Pennsylvania understands that going to combined reporting is not going to increase tax revenues day one. I think that there's truly a lag period in which any additional revenues under combined reporting will be in the future. And another thing I'm concerned about too is I think Pennsylvania addressed a lot of the concerns that they think combined reporting will cure. Combined reporting was always thrown out there with regards to stop certain tax planning strategies in Pennsylvania, specifically Delaware investment holding companies. Well, there's very few Delaware investment holding companies still being used for Pennsylvania purposes. And Pennsylvania already has legislation that provides intercompany transactions are to be added back through with affiliate entities if there's not a true business purpose. So I think Pennsylvania already has the ammunition to be able to add back without using combined reporting. So just my thoughts there. Pennsylvania has not always, for the last several years have been considering, we talked about the SALT cap. So Pennsylvania has been looking at what other states have done and create a pass-through entity tax structure. So it's the ability for shareholders to use the SALT cap and kind of get around the SALT cap and have the entity pay the tax, their tax associated with the business. Pennsylvania was dead set against this. And their first rationale is, hey, look, Pennsylvania, we just switched over to MyPath, a new computer system. And we just don't have the bandwidth to be able to have this new MyPath system, as well as creating a new pass-through entity tax and tracking that through MyPath. And it kind of made sense. You know, the early stages of MyPath had a lot of bumps and curves in the road. So I could kind of understand that rationale before. But as MyPath kind of worked its way through and things are working properly now under MyPath, Pennsylvania still has no appetite to create a pass-through entity tax system with regard to the SALT cap for federal purposes. It appears that Pennsylvania, specifically the Department of Revenue, feels that this is not, as you know, a taxing system that they want to get behind. They don't really see the true value of it, and they believe that its only benefit is for the very wealthy, and they don't see how it helps, you know, the normal taxpayer in PA. So there's really no appetite for going into and providing for the pass-through entity tax structure. One item that was being considered in the budget, which I was kind of hoping would be passed, was with regards to the non-resident credit. So pass-through entity taxing structures are used across the country in various states. For Pennsylvania purposes, right, you have a taxpayer, they're paying tax through this pass-through entity in various other states. For Pennsylvania, they provide a non-resident tax credit for taxes paid to another state. Well, Pennsylvania's Department of Revenue came out and they said, hey, look, we agree with the non-resident credit pass-through for the PTEs. However, we're based upon the language of our statute, that non-resident credit is only available for S corporations. It does not apply to partnerships. And we kind of pushed back on the Department of Revenue saying, well, this is really not fair. Pennsylvania said, this is the statute says this, and this is how we're following it. It's kind of interesting because I have not heard much pushback from the Department of Revenue denying non-resident credit pass-through entity tax credits at the partnership level. I'm not sure if they're just allowing it or if I'm just not hearing anything about that. So it's kind of interesting. It would be nice for Pennsylvania to pass the legislation to treat S corporations and partnerships similar with regards to the non-resident credit. There was discussion of accelerating that corporate net income tax rate reduction, right, that we talked about before to ultimately get to the 4.99%. I get concerned when we start talking about accelerating or even, you know, phasing down various taxes. Kind of jaded. Pennsylvania used to have a capital stock foreign franchise tax, and it was one of the, you know, the few states in the US that had a tax on the business income, corporate net income tax, as well as a tax on the net worth of the company. So Pennsylvania was trying to get rid of that. Some states had that structure, but it was an either or. You either base your tax upon the income or you base your tax upon the net worth. Pennsylvania was hitting both of them. And Pennsylvania decided, hey, look, we don't want this black eye anymore. So we're going to get rid of the capital stock foreign franchise tax, and we're going to phase it down until it's out of existence. Well, that phase down was scheduled, and it really, I'd say for 4 to 5 years, Pennsylvania kept slowing down the phase out of that tax, specifically during budget season. Whenever they determined that there were some revenue requirements, there's any revenue requirements associated with the budget, the easiest thing to do was slow down the phase out of that tax. So my concern with accelerating or decelerating a tax is the ability for a company to plan and understand what their tax liability will be in the state, right? If they're planning, say, hey, look, we're using the tax liability, the tax rate currently in place to come up with our estimates, that's one thing. But then if you're changing the tax rates midstream, I think that's an issue. So I was kind of glad that they did not accelerate the corporate net income tax rate reduction. So we talked about this current budget. Oh, sorry. We talked about this current budget. The biggest concern I see is what I'm reading from Pennsylvania's Independent Fiscal Office. And they said, you know, next year's budget, the next couple years' budgets are going to be not very pretty. They're calling for potential revenues to be stagnant in Pennsylvania, possibly be reduced. They're looking at expenditures in Pennsylvania to go up with regards to what the spend number is for the budgets. So we're looking at a potential structural deficit. And looking at the operating deficit that they projected for 2025, 2026, they're looking that the operating deficit will be over $3 billion. And by 2030, 2031, that number will be upwards of $7 billion. So briefly talked about the rainy day fund. It looks like it may be raining sooner than we think. And to make matters even worse, the Independent Fiscal Office also came out and they said, hey, look, here's our position on what we think tax revenues could be if we look at changing sales and use tax, changing the tax rates, changing the tax base. You'll see here there's a report on October 2025 issued by the Independent Fiscal Office, and it goes into detail as to various things that Pennsylvania would be looking to tax, right? Some states out there, they tax food. Pennsylvania may want to consider that with regards to offsetting the budget deficit. Services. Right now, Pennsylvania taxes all tangible personal property unless there's an exemption, and select services. Well, a lot of states out there don't have that select services. They tax services in general. So Pennsylvania may become more aggressive as to what they want to have the sales and use tax imposed upon. What does this also mean? I think you're going to see increased audit activity across Pennsylvania, whether it be sales and use tax, whether it be corporate net income tax. You're going to see additional discovery efforts through the use of business activity questionnaires. Pennsylvania is going to cast a wide net, and I think they're going to try to increase the tax rolls by getting new taxpayers here into Pennsylvania. Also see continued aggressive positions taken by the Department of Revenue. The one item that is truly worrisome is with regards to computer services here in PA. And I'll get into that further with regards to the current audit issues I'm seeing with regards to sales and use tax. And they may also consider increasing the personal income tax rate. So polling question, as a result of the 2025-2026 PA budget, what is the 2025 corporate net income tax? All right, the options are the budget did not impact the rate. It remains at 7.99%. The budget increased the phase down in 2025 to 6.99%. The budget increased the rate to 9.99%, or the budget replaced corporate net income tax with a gross receipts tax. Give you some time to answer that. And majority of you got that correct. The budget did not impact the rate for 2025. It remains at 7.99%. So Pennsylvania updates. We already talked about the reduction of the corporate net income tax scheduled to 4.99% in 1/1/2033. NOL legislation, there was some discussion about increasing the NOLs that can be used in Pennsylvania. Pennsylvania does not provide the use of all NOLs. They limit that. So, but they're increasing the limitation. Previously you were limited to 40% of your taxable income that you could use in NOL. That's limitation is still 40% for all NOLs generated before 2025. But for years after, they increased that 10% until it reaches 80% of your taxable income for NOL usage for scheduled to be for 2029. One thing I'd like to go over is Pennsylvania administrative appeals process. This is something I get involved with quite often. So just so you understand, you get an assessed tax, you get an audit, the Department of Revenue makes that assessment. The first phase of the game is going to the Board of Appeals to appeal that. Well, guess what? The Board of Appeals is run by the Department of Revenue. So you have to have clear, very obvious errors or mistakes, or just, you know, an overabundance of evidence to prove your case to really win outright at the Board of Appeals. The next phase is the Board of Finance and Revenue. And at the Board of Finance and Revenue, it's more of a kind of a court scene, right? It's myself representing the taxpayer or someone else, or the taxpayer themselves. On the other side is the Department of Revenue attorneys, and then you present your issues and arguments to a 3-member board. So the Board of Appeals, that takes anywhere from 6 to 12 months. The Board of Finance and Revenue can take anywhere between 6 to 12 months. And if you still don't get it resolved at the Board of Finance and Revenue, then you have to go to Commonwealth Court. And that's where my biggest concern is the appeals that are going up to Commonwealth Court. So we're looking at anywhere from a year to 2 years to get through Board of Appeals and the Board of Finance and Revenue. Now, once you get it to Commonwealth Court, we're looking at timing of 5 to 7 years to get issues resolved. And the main culprit for that is the lack of attorneys at Commonwealth Court. They're running at about half staff, so they're doing the best they can, but the timing is just ridiculous. And a lot of times I'm actually considering compromises at the Board of Finance and Revenue level just to get resolution to an issue in a more timely fashion. Another concern is currently Commonwealth Court, they're remanding certain cases, sales and use tax refund cases, back to the Department of Revenue attorney to make the decision. And that just does not seem fair, right? Pennsylvania the Revenue decided the assessment amount. Department of Revenue decided the decision at the Board of Appeals. At the Board of Finance and Revenue, the attorney for Revenue, they already had their mind made up as to what they think the correct answer is. Commonwealth Court in the past was the first time you would really get a true ability to compromise at a reasonable, equitable level. Now having that sent back to the same attorney that decided that Pennsylvania's position at the Board of Finance and Revenue just does not seem fair. So some other things you want to kind of keep in the back of your head is the Department of Revenue may now during an audit come into a closing agreement during an audit. That provides that you can go through and come up with some type of compromise at that level. Board of Appeals and Board of Finance and Revenue, they now have new online petitions available. So could spend more time on that, but let me go forward. So polling question 13, what is the most reflective comment associated with Pennsylvania's administrative appeals? Very satisfied with the administrative appeals decisions and timeliness. There's no opportunity to compromise in Pennsylvania's administrative appeals process. The concern is long resolution times, especially if reaching to court. Or lastly, all of the above are true. All right, and that is correct. Long resolution times, that's the biggest concern I have. Pennsylvania tax updates. Kind of heard some things out there with regards to repealing or reducing personal income tax, or replacing or repealing the property tax. Those are nice buzzwords, but in all actuality, it would be next to impossible to do that without, going back to a corporate net income tax rate of, above 9.99%, doubling the personal income tax rate if you're getting rid of property taxes, possibly increasing sales tax to 8 to 9% and taxing everything under the sun. So it just doesn't make any sense. The one thing I want to make sure you understand is the sales tax bulletin on help supply and building cleaning services. That provides, help supply is basically staffing. And what you want to make sure that you're aware of is that for this purpose, Pennsylvania provides, if you have a lump sum charge, that entire charge is subject to sales and use tax. However, if you break out the charge between a service fee component and the cost of the labor to provide that service, Pennsylvania will only tax the service fee component. In practice, before this bulletin came out, Pennsylvania was pretty lenient with regards to, all right, you can have some kind of rationale support document that would support a reduced tax, taking into account the cost of labor. But now Pennsylvania is adamant that you actually, on the face of the invoice, have to separate out the service fee versus the cost of the labor. And the concern there for people for providing these services is they don't want people to know what their service fee percentage is. So property tax rent rebate program, they increased the eligibility level and they increased the maximum rate rebate available. Brief blurb there about the EITC, Educational Improvement Tax Credit, and Opportunity Scholarship Tax Credit. These are very popular credits in Pennsylvania. The one thing I thought was interesting was the pre-K EITC had some credits available. So you want to make sure that you understand that if your clients can't get into the EITC program, they may want to look at the pre-K EITC program because there are still some dollars available there. So we'll quickly go through this. Pennsylvania, right in the middle of the pack. All things considered, it's better than where they were. When I first started doing tax updates for PA, they were being graded at about a D. So we're doing much better, but right in the middle, a little worse in the middle. Corporate net income tax, you know, we're getting better with the rate reduction. Individual tax, the big concern with that across the country is the difficulty with regards to the silo system, where you have 7 different silos and you have to use income expenses for that specific silo to offset income from that same silo. You can't, you know, use expenses in one silo to offset gains or income in another. What are some other Pennsylvania highlights? Pennsylvania gets a black eye with regards to their local tax structure, but they're not doing much to resolve that. I don't think the localities will do that. Business privilege tax, just be aware. I put this in here to kind of go through. If you have remote employees in Pennsylvania, or you have employees working from home, a locality may try to say that you are subject to their business privilege tax based upon having that individual within their jurisdiction. It was a lot hotter topic about 1 to 2 years ago. I haven't heard much of this since, but just something to keep in the back of your head. Pennsylvania audit issues, the help supply issue that I talked about, staffing, and a lot of these issues revolve around intercompany transactions as well. So if you have any intercompany transactions among affiliated members of a group, make sure that you have it documented. Make sure that there's an agreement. Make sure within that agreement there's no taxable service. Pennsylvania does not have a true object test, right? So if they view a transaction with a gross amount and they dig into it deeper, which I've seen during audits, and they find any taxable component, they could say the whole charge is subject to sales tax. Exemption certificates, make sure you keep them, make sure you're issuing them correctly. And the big one for PA, cloud computing and computer services. This is the main topic that I'm dealing with all the time. Pennsylvania never taxed computer services, but once they said, hey, digital products are deemed to be tangible personal property, including software. Now they're saying that if you're providing any computer service, you're basically touching that computer software, which is tangible personal property. To dumb it down, it'd be similar to, I have someone come out to repair my refrigerator. The refrigerator is tangible personal property. Service to that tangible personal property is also subject to tax. So not many people are really focused in on this. Pennsylvania is going after the big players right now, so they're going after the Microsofts of the world. But at some point in time, it's going to come down to the smaller businesses here in PA. And briefly go over a multi-state tax update. Sherry's going to go over some information with regards to Maryland. Sorry, my slides here are stuck. Okay, nexus concerns. States are tackling Public Law 86272. They're stating that the protections under 86272, where a state can't impose its income tax for the solicitation of sales of tangible personal property, they're being very aggressive. States are being very aggressive in attacking this. Remote employees, that's another thing across the country. If you have a remote employee, you're on the state's radar. Software as a service, not just in Pennsylvania, but across the country. You know, example, Arizona, payroll service, never taxable. Now that ADP is offering payroll services through an application on someone's phone, now they're saying that providing that service through the application, the software as a service, is now a taxable transaction. And the expansion of the sales tax base. States like Texas, Maryland, Washington, they've expanded upon the tax base, and now they're including data processing services, computer services, and Maryland digital advertising. So I have a slide on the digital advertising tax in Maryland, and that is very important to keep an eye on. Maryland's being aggressive in going after a digital advertising tax. Everyone across the country, all the states across the country are looking at this and seeing what happens. So now it's based upon having $100 million of global annual revenues, at least 1 million derived from revenues in Maryland, and they're looking to tax the global revenues associated with this digital advertising. The case is extremely interesting. Various companies are in court right now fighting this tax, from constitutional concerns to, you know, everything under the sun. So keep an eye on this. It is very, very interesting and very, very important going forward. Sorry, I went over my allotted time, but if anyone has any questions or concerns, please feel free to reach out to me. My phone number is there, as well as my email, and I appreciate your time today.
Perfect. Thank you so much, Jason.
All right, before we get into the Maryland tax updates, just a couple of things circling back around to our individual update earlier, some questions that we had either looked into or hadn't had time to cover. Then around the overtime, no tax on overtime, I just mentioned that you know, the calculation could be a little bit more complicated than might first seem. And somebody had asked about specifically non-discretionary bonuses, and if those were the ones that type of bonus would be included in the overtime calculation. So just to follow up on that, I did check in with our payroll team, and so non-discretionary bonuses, ones that are the ones that are included. Discretionary bonuses would not be included when making that regular pay rate calculation for overtime. Just to give you a sense of what that means, so a non-discretionary bonus might be something that's calculated based on a contract, based on some sort of metric or goal that somebody is expecting as a bonus. That would be a non-discretionary bonus. That's the type that would be included. Discretionary bonuses not included would be things like your holiday bonuses, something that is a one-time unexpected bonus given to your team. That would be that. And then somebody else had asked a question about whether or not tips would be included in the regular pay rate in the overtime calculation. And not all tips, however, if you're familiar with tips and the tip credit that employers can take, there are certain tips that you have to pay payroll taxes on, which bring up, say, a waitress's salary or payroll to the minimum wage. You may be able to pay a tipped employee lower than the federal minimum wage. However, you need to bring them up to the minimum wage, and then you can take a tip credit for that. If you're in that situation, yes, there may be a portion of the tips in order to get you to that $7.25 an hour, which is the current federal minimum wage. You will need to consider that full minimum wage as the regular rate of pay to calculate the overtime. So it's a little bit confusing, a little nuanced. I would encourage you, since this is kind of that piece of the calculation is really outside the scope of this specific webinar, and it can get very detailed and very tailored to your specific needs and the way you pay your employees. So please reach out to your tax advisor if you have any questions on how to do that calculation. This is the FSLA regulation, so that's been around for a while. So hopefully we are doing that, but I think we're going to find that perhaps when we're looking at this a little bit closer in calculating this for the W-2s going forward, you may want to reevaluate, make sure you are following all those specific rules for overtime. Also, we had a question: if an employer contributes to a Trump account, is that deductible for the employer? And that is the case. So the employer would deduct that as wages, as long as they are made under a separate written plan that complies with the non-discrimination rules, like somewhat similar to a plan you would have in place for a dependent care FSA or flexible savings account. So hopefully that addresses the questions I think that we got in for the individual section. So moving on to Maryland tax updates. So like Jason was mentioning about the Pennsylvania budget not being passed until just recently, and that there were no tax increases as part of that budget, Maryland's a little different situations. They did pass their budget on time, but they have several tax increases this year that they used in order to close that gap in the budget. Individual tax rates are new brackets and rates. For the longest time, our highest Maryland tax rate was 5.75%. As of this year, beginning in 2025, so this took immediate impact on Maryland residents or Maryland income. If you are in over $500,000 and under $1 million for single, you have a 6.25% bracket, and joint over 600,000 and up to 1.2 million at that bracket. And then they added the highest bracket here now in Maryland is 6.5% if you have income over $1 million for single or joint or head of household of $1.2 million. So that is again applicable to 2025 tax returns. And just so you know, obviously that impact did not come about until, you know, we were at least 4 months into the year for 2025. So interest for underpayment of estimated taxes will be waived for 2025 if the underpayment would not have been incurred, but for the increase in the income tax rates. Another tax increase this year, Maryland will be imposing a 2% surtax on net capital gains that are included in Maryland adjusted gross income if the federal adjusted gross income exceeds $350,000. And that $350,000 adjusted gross income amount is for any filing type. So regardless of your filing status, federal adjusted gross income exceeds $350,000. In Maryland, if you have gains in Maryland, you will be subject to an additional 2% surtax on those capital gains. They are excluding certain types of gains, primary residence sold for less than $1.5 million, assets held in a cash or deferred arrangement plan, like 401k, you know, all your retirement plans, basically, you know, we don't pay gains tax federally on that, so it's not going to show up as a gain really. certain livestock, if at least half of the individual's income is from farming or ranching, there's certain types of livestock you can take capital gains treatment on at the federal level. In that case, those would not be subject to the 2% surtax. Land subject to conservation, agricultural, or forest preservation easement that will continue to be subject to those same preservation easements after sold. So any gain on that type of property also excluded. And then of course your property used in a trade or business where the cost is deductible under section 179, which Ryan went over earlier, what those types of assets are that are deductible. As long as it's that type of asset, capital gains would be excluded from this specific surtax. Just to real briefly mention what that does. We talked about the Maryland rates being like the highest bracket being a 6.5% rate now. It was 5.75%. So those higher brackets there, if you are falling into those brackets, you may think that your Maryland rate was higher before, but that is because unlike PA, it has a separate local tax return. In Maryland is a state that has a separate local tax, which is a county-wide tax in most cases. And that tax is piggybacked on your Maryland tax return. So a lot of them are in the 3% range. So consider someone who's in a 5.75% bracket for Maryland income tax. They live in Carroll County, Westminster, have an additional 3.03% local tax in the county. And then you add, they have over 350,000 gross in adjusted gross income, add that 2%, you're looking at a capital gains rate in Carroll County of 10.78%. Frederick, our other Maryland office is located in Frederick, their local county taxes basically ranges from 2.25% to 3.2%. So you could have as high as 11.7% capital gains rate in Frederick if you're at the higher end of the income bracket. So just to let you know that is some pretty high state tax rates. So again, maybe another plug for the Maryland pass-through entity tax deduction if you are in that situation and have that opportunity. Individual tax itemized deductions. We talked a little bit about, Matt, I think, talked about the PEAS limitation that used to be in place under federal law. And then, that had gone away. Now there's a different type of itemized deduction limitation. Maryland had previously had basically a PEAS limitation implemented as well. And they have now set their thresholds for itemized deduction phase outs beginning when federal adjusted gross income exceeds $100,000 if you're married filing separate, and $200,000 for all other filing statuses, including single or married filing joint. So if your federal AGI is over $200,000, then you start to have a similar limitation as under the old PEAS limitation rules. So you'll see that this is a very familiar calculation where the amount of itemized deductions otherwise allowed on the Maryland return would be reduced by 7.5% of the amount of federal adjusted gross income in excess of the applicable threshold. So it was very similar. So this is, Matt kind of talked about how interesting it is to see the impact of the new increased SALT limitation in the itemized versus standard deduction. Keep in mind that in the state of Maryland, you must itemize for Maryland if you itemize for federal. You must take the standard deduction for Maryland if you take the standard deduction for federal. And then the standard deduction in Maryland is far lower than the standard deduction for federal. So it really, you need to start calculating those. We've been doing that for years, but you really need to calculate both ways to see if your overall tax liability, you could, maybe increase your federal tax liability just a little bit taking the itemized deductions, even if they're less than the standard on your federal return, and still make out on your Maryland return far more. Because just remember, your state and local income taxes are not deductible as an itemized deduction in the states. So just something to really keep in mind. It really takes a little bit of thought and process to determine which way you need to do that standard or itemized. It's not always straightforward. Then we have a polling question. True or false? Maryland imposes a 2% surtax on net capital gains for individuals with federal AGI over $350,000. True, 85%, and that is correct. It begins in 2025. So pass-through entity taxes, we talked a little bit about how Jason said, mentioned that PA does not have that. However, 36 states and New York City do have a pass-through entity tax of some kind. There's only a handful of states that have an income tax that do not have it, PA being one of them, Delaware, another close by, DC, Maine and North Dakota do not. However, Maryland does, and as you can see, based on some of these discussions on the increased tax rates, new brackets, it may be something to really consider, even if you think that you might be okay with the $40,000 limits. The definition of pass-through entity taxable income was revised under Maryland's new budget. For resident pass-through entity members, the definition was amended so that income includes the members' distributive or pro rata shares of pass-through entity inside and outside Maryland. So this could cause, again, this does not apply till 2026, but I just want to get everybody ready for this, especially if you're doing estimated tax returns for 2026 when you do 2025 returns, because you do have to make that election on the estimated tax forms for the following year when you make your first payment. So if you have resident members of a pass-through entity with Maryland income, that income in the past for the pass-through entity election only really was calculated on their Maryland income apportionment. So if you have multiple states, so really this applies if you have multiple state entity, files in Maryland, you have Maryland resident owners, right? Those resident owners now, the PTE tax will be paid in on 100% of their pro rata income, not just what was earned or attributable to Maryland. So if you have resident and non-resident members of those S Corps, that may be a problem, and you need to start thinking about that moving forward, how you would address that. So again, that's going to increase your PTE tax paid for Maryland resident members if you have a pass-through entity making the election in Maryland and you have more than Maryland income, okay? Maryland decoupling, Jason was talking a little bit about Pennsylvania and how some of the other states are doing this. Maryland automatically, they have a law in place. If you're not aware, Maryland, of course, starts with federal adjusted gross income and kind of makes some adjustments from there. They do have a law on the books for a while now that does some calculations of financial information from federal law changes, and it automatically will decouple from certain provisions. So under those rules, Maryland has automatically decoupled for tax year 2025 from the full expensing of domestic R&D or R&E expenses. Pat was going over some of that and how the different states are handling that. Maryland has fully decoupled from that. So at least for 2025. So if you have that and you're taking the deduction for federal purposes, there will be a decoupling modification necessary to add back, and you will continue to amortize those expenses for Maryland. Special depreciation allowance for qualified production property. So Ryan was talking a little bit about the additional depreciation for qualified production property, expansions of manufacturing property. Maryland has decoupled from that provision, so you'd have to depreciate it over a longer period of time. Modification of the limitation on business interest deduction. So they also, Ryan was talking about the business interest deduction limitations, where we're now going to be able to utilize or add back certain expenses like depreciation, amortization, to get to those calculations to determine how much is disallowed. For Maryland tax purposes now, they are saying no. We've decoupled from that. So, so for the tax year 2025, those three big things will be included on the Form 500 DM for decoupling, and we'll need to report those decoupling modifications for all those items in tax year 2025. To point out that that law really only applies to the first year. The Maryland legislature will convene in 2026 and determine whether to permanently decouple from any of the provisions in OBA, which then would be reflected on forms for tax year 2026 and later. Just to keep in mind where we'll be looking for that information will be at the beginning of the year, because unlike some states, Maryland is kind of unique in that they only run their legislature through a very short period of time. So they convene in January, mid-January, and they wrap up their legislative session for the year mid-April. Can only really be extended, can sometimes be extended for another month, but we don't see that too often. So basically we should have the answer to those things by the middle of April to see how 2026 and forward will be handled, Maryland decoupling. Just real quick to address, since the no tax on tips, no tax on overtime, no tax on automobile interest, additional deduction for seniors, all of these items aren't in the auto decoupling provisions, but that's because they don't impact the Maryland forms and calculations, because they're all below the line deductions. Like I said, those are all deducted on the 1040 after adjusted gross income. Maryland starts at adjusted gross income. There's also the higher federal SALT limitations and federal standards. I kind of already went over that, how you calculate federal and Maryland both to see which creates the lowest overall tax liability, because you have to follow whatever you follow for federal in Maryland. And then Jason kind of went over like a few things that she was mentioned about the Pennsylvania and how they're trying to kind of pull in cloud computing with the help supply service, that type of thing. So Maryland kind of handled this a little differently. They didn't, the sales tax law for services in Maryland really, they have basically services are exempt from sales tax in Maryland unless it's specifically listed as a taxable service in their sales tax law. So what Maryland did to get in on all of that revenue was they created their own what they're calling a tech tax. So they have a separate 3% sales tax rate effective July 1st of 2025, specifically on information technology services. And those things are under very specific NAICS codes. They're all listed here in the slide, but that's things like cloud computing, cloud storage, hosted backup, web hosting, related services, data processing, data services, IT consulting, software development services, systems integration, and then of course your software as a service, subscription models. So they already had a sales tax, 6% sales tax is their normal sales tax rate. They already have that instituted that in the last couple of years on digital assets, so digital property. So there was a little bit of a distinction between sales as a service and a digital software. So it did come into play here if you do have the software as a service, and it's considered a service and not a digital asset under those rules, it's subject to the 3% tax and not the 6%. So it's a little bit of a nuance there. I'm just going to say too, to comply with this, all vendors in state, so a lot of these people providing those services didn't really have a sales tax license. They didn't have anything that was taxable before. Any vendors in the state of Maryland who have customers in Maryland must register and collect and remit 3% tax when applicable. Out-of-state vendors, if they have economic nexus in Maryland, would also need to register for this sales tax account. And if you're not familiar, that's basically you have $100,000 of remote sales into Maryland, then you're considered to have out-of-state nexus, economic nexus in Maryland for this purpose. So you would then be required to charge your Maryland customers for that 3% tax and collect that. Maryland Tax Connect is where you would register for the number, the sales tax license, and also file the sales tax returns. Sellers must classify services to determine if the 3% tax applies. So don't just look at your NAICS code on your tax return. You have to look at each individual service and determine if that falls underneath that type of activity. Also beware if you have bundled services, if they are not properly itemized, it could make the entire bundled service subject to 3% tax. I think Jason kind of mentioned that as well under his presentation as being something that's important when you have bundled items on your invoicing. Some are taxable and not taxable, then they end up all being taxable. So you want to be careful on that. And just one more, exceptions to those services that are taxed, nonprofit or governmental entities. If you are getting IT services in Maryland, you'll want to make sure you provide your exemption certificate to the vendors that are providing that so that they have that on file and would not then be required to charge you that 3% tax on the service. There's also something new called a multiple points of use certificate. So if you are buying a service subject to this tax in Maryland, but you have multiple locations located in multiple states that are actually benefiting from that service, you can apply for a certificate, a multiple use certificate from Maryland through Maryland Tax Connect. Once you get that certificate, you would then provide that to the vendor or to the person providing the service. Then that vendor would not charge you this 3% sales tax on their services provided to you, and you would instead do a calculation allocating what services are being used in Maryland, and then you would then pay that as a use tax to Maryland through Maryland Tax Connect. So that's kind of a new concept, and they're currently requiring it to be approved by Maryland for each transaction. There is some talk about how that might be feasible to change a little bit more like a blanket certificate like they do for other things in the future, but right now it's by transaction. If a service will be resold in its original state, the buyer should issue a resale certificate to the subcontractor. So just think, you're providing software development services as the contractor, but you have a subcontractor working on that software development for the end user, your end customer. That subcontractor, you should issue them a resale certificate. Otherwise, that subcontractor located in Maryland, providing that service to you in Maryland, would need to charge you the 3% sales tax. If they have a resale certificate from you, they do not need to do that. And you would then charge it onto the end user, or if they're an exempt organization, government entity, then they would be exempt under the other exemption. So provided a link to the website and technical bulletin information for you, because they do give some really good examples in the technical bulletin as to when you would use a resale certificate, what really applies, and all the exemptions and how to use these things.